Mahendra bhai, we can start. Bhadresh bhai, you there, right?
Yes, I'm there very well.
Yeah. Yes, Mahendra bhai.
Bhadresh bhai, shall we start the meeting, sir?
Yes.
Yeah. Dear members of Dadar CP Study Circles, I welcome you all to this study circle on the very hot topic of the proposed amendments in the direct tax. We usually wait for this budget to announce and then really crack the budget with the integrities of the budget proposals, because there are host of amendments. This year, if you notice, there are almost 82 clauses proposed in the direct tax amendments, least in the rates of taxes, but at the same time, heavy amendments in the charitable trust provisions, as well as very serious amendments in the section 68, as well as some of the amendments like updated return. I know there are lots of small and interpretational questions may arise in the minds of all of us. And we have a very learned speaker today with us, CA Sri Bhadresh Doshi, very learned personality and practicing for the last more than almost 2 decades, and very knowledgeable personality to make us aware about what is the integrity and the nitty-gritty of the budget, as well as with the vast experience that he has got in the field of the direct tax. I am sure that all of us will gain from his knowledge and his experience really what amendments that has been proposed in the budget, how it is going to impact to the taxpayer, and what are the really serious impacts which will be understood with the detailed analysis given by the Bhadresh bhai, like section 68, really a worrisome amendment, as well as there are some amendments, welcome amendments, like section 56, where the COVID related reimbursement, if it has been given to the any employees or any related parties, non-related parties, even those have been relaxed. I really say that it is a welcome provision. But at the same time, though it has been amended retrospectively, I doubt really the people who have already filed the returns for the previous years of 1920 financial years as well as 2021, how those all needs to be taken care of, as well as what are the really provisions which are there in the updated returns, like section 139(8)(a), and what care one needs to take when we declare, whether it is in VDIS scheme that, or it is really a concern where serious implications can come on the taxpayer also. There are new provisions also introduced in this budget, like virtual digital asset and its taxation policies. There are some amendments to a very hot topic which all of us may be facing, of a section 148 and so on. There are few changes in the penalty provisions also, and I'm sure with the help of the learned speaker like CA Bhadresh Doshi, we will be much more in detailed study on the amendments proposed in the direct tax bill. With this introductory remarks, I welcome to Bhadresh Doshi sir, and I request Parin bhai to take up the proceedings further of the study circle. Parin.
Thank you, Mahendra bhai. Before we start the session, as a what we say is a protocol, we would like to have ICI motto on our screen. Let's have that.
यशस्वतेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः तदेव शुक्रं तदब्रह्मा तस्मिन् लोकः शतः सर्वे तनूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
With this ICI motto, I would now like to invite CA Siddharth Karani to formally introduce our today's speakers, Shri Bhadresh Doshi. Siddharth.
Thank you, Parin. This is the second opportunity in last 10 days where I'm getting the opportunity to introduce Sri Bhadresh Doshi formally. Thank you. Bhadresh Bhai is a BCom graduate from Mumbai University. He's a chartered accountant and he has cleared in November 2001. He has secured merit rank on all over India basis throughout all the CA exams, and he had achieved 23rd, 33rd, and 11th rank in CA Foundation, Intermediate, and Final respectively. He has also done Advanced Diploma in International Taxation, that is ADIT, and he has cleared paper on Principles of International Taxation as part of ADIT course conducted by Chartered Accountant Institute of Taxation, UK. He is into practice as Messrs. Bhadresh Doshi and Associates since last 19 years. His core area of practice are litigation matters up to ITAT levels and consultations on income tax matters, including international taxation. He is a member of Managing Council of Bombay Chartered Accountant Society. He is a member of General Committee and Taxation of BCS. He is a member of General Committee of CTC. He has co-authored of controversial article which is published every month in BCA Journal. He has authored a book on Income Declaration Scheme 2016 for BCAs, which he had an occasion to present it to Honorable Finance Minister Mr. Arun Jaitley. He had been a paper writer for BCA RRC. He has co-authored of budget publication and referencer of BCAs. He has taught direct tax to CA final students for 7 years. He has written several articles on income tax which have been published in CA Journal, Taxman's Journal, etc. And he has also presented papers on taxation at various forums. Thank you, Pari.
Thank you, Siddharth. Before we give the floor to Bhadresh Bhai, I would like to request CA Chintan Rambia to present an e-certificate as the mark of our love and appreciation to Bhadresh Bhai.
Bhadresh Bhai, this gives me an immense pleasure to provide you with this e-certificate as a mark of appreciation and love from the study circle. Request you to accept this e-certificate. I know we are in tough COVID times, but as soon as the अभी नजदीक आ रहे हैं हम धीरे धीरे फिजिकल में, so we would absolutely like you to hear you physically, but in these tough times request you to accept this e-certificate, Bhadresh Bhai.
Bhadresh Bhai, the floor is yours, and we would definitely very eager to hear you.
Thank you. Thank you. So my screen is visible to you?
Yes, sir.
Yes, yes.
Okay, thank you. Okay, so all the conveners and committee members of Dadar East CP Study Circle, Mahendra Bhai, Parin, Siddharth, and Mr. Rambia, good evening to all of you, to all the participants. Let me first thank you all for giving me this opportunity to study the subject of Finance Bill 2022, the direct tax provision, and to share some of the points which I could gather, I could understand from the this Finance Bill 2022. Friends, we have about 2.5 hours to understand this particular subject. So the idea is not to present all the changes exhaustively which have been proposed in this Finance Bill 2020 under the Income Tax Act, because nowadays we are in this age of WhatsApp, and we have all the information which is available on WhatsApp and Google. So idea is not to discuss exhaustively all the changes. The objective of this presentation would be to concentrate on some of the important changes which probably will be relevant for all the participants in general, which might be applicable to all of us in our day-to-day practice. So with this objective, what I've done is that I have grouped all the amendments, the important amendments rather, into 12 or 13 different groups, and accordingly I have prepared this presentation. So I'll be running through this presentation. Probably we will not be able to discuss the whole of this presentation which is available, but of course I am going to share the whole of this presentation with you, so you will have a benefit of my presentation. But whatever is important and whatever I'll be able to cover in this given limited time, I'll be covering them. So So when this finance minister presented this budget 2022, and more particularly the finance bill 2022, with reference to the amendments which are proposed under the Income Tax Act, what I could see, friend, is that the number of favorable changes in the Income Tax Act are quite lesser as compared to number of adverse changes. And when I say the number of favorable changes, I think that hardly there are 2 or 3 amendments in the Income Tax Act, if you study the whole Finance Bill 2022, which might be resulting into some benefits to the taxpayers at large. When I am talking about favorable amendments, friends, I am talking about the favorable amendments which might result into some benefits to the taxpayers at large. I am not talking about certain group of the taxpayers for whom might be there are some changes which might benefit them. So I was just wondering as to what could be the reason of this, as to why the favorable amendments have not been proposed in this Finance Bill 2022. And I realized that many things were already done in the past. So if you consider the past history of last 2 or 3 years, we have witnessed and we have seen that there are a number of favorable changes which have already been made effective, including the reduction in the tax rates for corporate SSEs, 22% scheme, even 15% of tax rate scheme for manufacturing companies, even the reduction in the tax rates by giving optional tax regime for individuals and HUFs, etc. So many things have already been done. And that could be the reason as to there was no further scope for giving some benefits, reducing the tax rates, giving more exemptions and concession. But friends, what I could see is that there were many other things which could have been done. So for example, what are those things which I'm referring to is, say, for example, the list is very long, which I have. I'm not going to discuss the entire list, but just to share a couple of them, is that the first one, which is always on my target, is the presumptive schemes of taxation, 44AD or 44ADA. All of us know that in many of the cases, or rather in majority of the cases, this presumptive schemes of taxations are resulting into some kind of a hardship to the taxpayers rather than giving some benefits to the taxpayers. And therefore, many things are required to be done in order to simplify this presumptive schemes of taxation, and that too more particularly in this COVID time. So in this COVID time, expecting the small taxpayers to offer their income at certain percentage of turnover, and then imposing the condition that if you are not offering this minimum amount of income, you need to maintain your books of accounts, you need to get the books of accounts audited, making them disqualified for another 5 years from opting for this presumptive schemes of taxation, particularly in this COVID time, is unjustified, unreasonable. Many things could have been done for simplification of this presumptive scheme of taxation. Instead of talking about disallowance of cess, etc., which is a proposal which we are going to discuss, perhaps there was a need to abolish the cess forever. because the cess, etc., was introduced for a temporary period of time. When it was introduced for the first time, I recollect that it was being mentioned that it was only for a temporary period of time. And we have seen that this temporary levy of cess has now become permanent. Okay. And not only it has become permanent, it has been increased over a period of time, the rate of cess. And therefore, there was a need to now remove the applicability of cess, etc. So, lot many such things, small things probably could have been done through this Finance Bill 2022. But nevertheless, whatever we have for the purpose of our study, we are going to study all these amendments, whether they are favorable amendments or whether they are adverse amendments. So I'll begin with this analysis of this finance bill and the changes, important changes rather, under the Income Tax Act. So the first one is on rate of tax. There are no major changes, or rather there are no changes at all with respect to the tax rates, except for this one, where the rate of surcharge, which is applicable with respect to individuals, HUFs, etc. There's a small change which has been proposed now. We know that we have been given different rates of surcharge depending upon the level of income of the individuals in HUF SSE. The peak rate of surcharge is 37%. But there is a beneficial provision which says that the rate of surcharge will never be more than 15%, irrespective of the amount of income, when the tax is being calculated on certain specific types of income. And what are the specific types of income which are covered under the present provision is number one, dividend income, and the second, capital gain which are arising from STT paid transaction, whether it is a short-term capital gain and therefore taxable under section 111A, or whether it is a long-term capital gain and therefore it is taxable under section 112A. So if the tax is calculated on this specific types of income, in that case, the surcharge on this tax liability cannot be more than 15%. Now, one more category of income which has been added to this list of income, and that another income which is now proposed to be added is the long-term capital gain, which is becoming taxable under section 112. So what is that change? The change, friends, is that earlier the benefit of the rate of surcharge not being more than 15% was available only to a long-term capital gain which is computed under section 112A, that is a long-term capital gain arising from STT paid transaction. But now this benefit is available to any long-term capital gain. That long-term capital gain need not be from STT paid transaction. So if you are holding an immovable property and immovable property was otherwise a long-term capital asset, if this immovable property is transferred, then the resultant long-term capital gain, when the tax is calculated on this resultant long-term capital gain, the surcharge cannot be applied for a rate of more than 15%. So depending upon your total amount of income, the rate of surcharge will be determined. But with respect to this long-term capital gain, now the rate of surcharge can never be more than 15%. So that is only a one change which has been brought with respect to the rates of tax. I'll proceed with the second very important set of amendment which deals with filing of an updated return. Before I discuss this provisions dealing with filing of an updated return, let me tell you first the background behind this proposal for bringing this provision enabling the SSE to file the updated return. It has been mentioned in the memorandum that currently at present under the Income Tax Act, Section 139 provides for filing of a return of income. And if you look at this provision, the taxpayers get a very limited time period in order to file their returns. There is a regular date. Forget about this extension due to this COVID or some other reasons, etc. But generally, if there is no extension, first we have due dates which are applicable for filing of return with 31st of July and 31st of October. And then if the due date has been missed, we have an option of filing of a belated return. Or if the returns have already been filed, but there are some mistakes which have occurred in those returns which have been filed, we can file a revised return. But whatever it may be, whether you are filing a regular return, revised return, or a belated return, the time period to submit this any type of return gets closed by 31st of December of that particular assessment year. And therefore, since this limited time period is available for any person to file the return, what is happening is that the Income Tax Department, on the other hand, is conducting a data mining. And as a result of this data mining, certain cases have been found where there is a mismatch between the high value transaction which have been reported in the data available with the income tax department vis-a-vis the ITR status of that person. Many cases have been identified where though the persons have executed high value financial transaction, but correspondingly no ITR is filed, or ITR is being filed, but the corresponding income arising from this high value financial transaction has not been reported in the ITR which have been filed by those persons. And therefore, these are the cases where it results into a mismatch. Now, if it results into a mismatch, today what is happening is the department will have to conduct an assessment proceeding, whether it is a regular assessment under section 143.3 or a reassessment for that matter under section 147. And the additions are required to be made while finalizing the assessment order. And in many of the cases, the taxpayers then disputes this assessment order by filing further appeals, etc. And therefore, it increases the litigation. And therefore, the objective here is that to create an environment where the taxpayers might be informed about any such mismatch which are arising in their cases, and option is given for the taxpayer that they can come forward voluntarily by filing this updated return, and whereby they can offer that particular amount of income, pay the tax liability on their own, and which will have two benefits. The taxpayers will be, getting a taxpayer-friendly environment where there is no assessment which is taking place in those cases, and at the same time, for the government, it is resulting into an easy collection of additional revenue, which otherwise they would have collected in the form of the assessment orders and then raising a demand and then recovering the demand, etc. With this particular objective, there is a proposal to provide for a specific provision for filing of an updated return. Now, before I discuss these provisions, which are for filing of an updated return, one of the important comment which I want to make here is that if you look at the memorandum, in the memorandum, openly this has been admitted that the additional time limit which is available at present under section 139 for filing of a revised or a belated return is not adequate. Friends, you must be aware that earlier for filing of such kind of a revised or a belated return, earlier the time limit available was 1 year from the end of the assessment year. Over a period, that one extra year which was available was removed and the time limit was reduced to only till the assessment year. And by the last Finance Act 2021, this time limit was further reduced by 3 more months, and 31st December of the assessment year was the last date by which the filing of such a return, that is a revised return or a belated return, was made possible. So over a period, this time limit has been reduced, and now today in 2022, the government mentions in the memorandum that the additional time limit which is available for filing of a revised or a belated return is not adequate. Now, point here is that if you yourself is admitting that this time limit available is not adequate, first of all, there is a need to make that timeline adequate. Okay, and then this kind of a proposal should have been introduced. That is the the point which I wanted to make here. So with this background behind filing of an updated return, let us proceed to understand the provisions now. Section 139 is a governing provision which provides for filing of a return, and this within the section 139 itself, subsection 8A has been now inserted, which provides for filing of an updated return. So we have now a different type of a return: regular return, belated return, revised return, and now we have a concept of an updated return. Friends, please note that this updated return can be filed. First of all, I'm just making the concept of an updated return very clear, and then we will be trying to understand the nitty-gritties or the issues which are arising out of this provisions of subsection 8A for filing of an updated return. The updated return can be filed in a case where you are increasing your taxable income which was already offered by you, if at all, if you have already filed your ITR. So this is only for the benefit of the government. This is not a favorable amendment in favor of the taxpayers. This is an amendment which basically tries to favor the revenue department. So you have to offer some additional amount of income while filing this updated return. And second, As a result of an offering of an additional amount of income, there will be a tax liability which now be payable. This tax liability needs to be now paid along with some additional amount of income tax. So by just paying the tax which was anyway otherwise payable by you, you cannot file an updated return. Since you are filing an updated return and window which is available for you to cure whatever defaults which had already occurred in your case earlier, now, since this option is provided, you have to utilize this option, but by paying some kind of a penalty. That penalty is in the form of additional amount of tax that is not named as a penalty, but it has been named as an additional tax. So these two important points are required to be kept in mind for the purpose of understanding of this provisions related to this updated return. Now, the first point is that who can submit this updated return? Is any person is free to submit this updated return, irrespective of whether that person had already filed his ITR earlier or not. Even in a case where you had filed your ITR, might be a regular, belated or revised, or even in a case where you were a non-filer, you had never filed your ITR for that year, in any of these cases, you are free to submit this updated ITR. There is a negative list that your case falls into this negative list, then only you are not permitted to file the updated return, but otherwise in general, you are allowed to file this updated return always. So what is that negative list that we need to understand, and that is something which is very important for us. So when this updated return cannot be filed, the first case is a case where you had already filed your updated return earlier. Now, this condition is required to be seen with respect to the same assessment year. So this restriction is qua assessment year, and this restriction is not qua that person. It is not that it is a once in a lifetime opportunity that you can file your updated return only once during your entire life. That is not the case. The restriction needs to be seen whether you have already filed your updated return for the same year. If yes, then you are not allowed to file a second updated return for the very same assessment year. But for other assessment years, you are still allowed to file this updated return. A notification might be issued, and in certain cases, if they are being notified, those persons who are notified for this purpose cannot file their updated return. So basically, the politicians should be the one who should be notified for this purpose, and they should not be allowed to file their updated return, because they should always come clean when the return is being filed for the first time under the regular provisions. There are further restrictions which are applicable depending upon what is the end result of your updated return. If the end result of the updated return falls into this particular list, you are not allowed to submit your updated return. So number one, if it is a loss return. So if you are declaring a loss in your updated return, you cannot submit this updated return with a loss. The second one, if your updated return is reducing your tax liability, which has been determined on the basis of ITR, which has already been filed by you. And third one, if the updated return is resulting into increase in the claim of a refund. So if either it is resulting into a reduction of a tax liability, or alternatively, if it is resulting into an increase in the refund claim, then also you are not permitted to file the updated return. I have already clarified this particular aspect, that by filing an updated return, you need to offer an additional amount of income tax, additional amount of income, and as a result, it should be resulting into a payment of some additional tax liability. So here is a case where you are trying to reduce your tax liability by reducing the income, and that is something which is not permitted under an updated return. So in these three cases, you are not allowed to file the updated return. Barring these three cases, irrespective of what is the end result of your updated return, you are free to file this updated return. There are further restrictions which have been placed on filing of an updated return in the cases where some of the actions have already been taken by the IT department for the very same assessment year for which you want to file your updated return. And what are these actions? If any proceeding for assessment or reassessment or recomputation or revision is pending or it has been completed. That means any proceeding of the assessment has already been initiated, or it was initiated and it has already been completed, in that case, once again, you cannot file an updated return in that for that particular assessment year for which that assessment proceeding was initiated or that assessment proceeding was already completed. If any prosecution proceeding has been initiated before you are filing the updated return, then also you are not permitted to file this updated return at all. If the assessing officer has received some information pertaining to the same assessment year in your case, and that information has also been communicated to the assessee, if these two conditions are satisfied, then also in that case, that updated return cannot be submitted by that assessee. Now, this information should be an information which is received by the assessing officer either under double tax avoidance agreement related to some tax evasion or arising out of some cross-border transactions, etc., or that alternatively that information could be an information under certain specific acts which I've listed in my slide. So, for example, Benami Act or PMLA Act, etc., which has some or the other consequences under the Income Tax Act, and therefore might be possible that proceeding is first initiated under those respective acts. The assessment proceeding under the Income Tax Act has not yet been initiated, but since at the end of the day it is going to result into some kind of an assessment under the Income Tax Act, a similar restriction has also been placed upon filing of an updated return even in this particular scenario. The last restriction is a case where the actions which are in the form of search or a survey which has been conducted by the department. So earlier restriction was a restriction only in the case where the assessment proceeding has been initiated or some information was received and the information has been provided to the assessee. But now we are talking about a specific case where either search under section 132 or a requisition under section 132A. What is a requisition? Requisition is a case where under some other act, some assets or books, etc., have been seized, and now the income tax department is calling for those assets or books, etc., because they want them for the purpose of making the assessment. So in a background of this requisition, behind this requisition, there is a seizure of something under some other acts. So either a search under section 132 has been conducted, or requisition has been made under section 132A, or a survey has been conducted under section 133A. When I'm referring to a survey, friends, I'm not referring to a survey for the purpose of TDS or TCS, etc., because that kind of a survey has nothing to do with making of an assessment of an income under the Income Tax Act. So barring that, all types of search, requisition, and survey is being covered here. And if this search or requisition or survey has taken place in your case, then in that case, you will not be allowed to submit the updated return. And this restriction on submitting this updated return will apply to you not only for that year of search or survey, but that will apply to you also for 2 preceding assessment years. So updated return cannot be filed in case where the search has been conducted, requisition is made, or survey is conducted, not only for that year of action, but also for 2 preceding assessment years. So the updated return cannot be filed for 3 assessment years. When we'll be moving on to the next slide, we will understand that the time limit available for filing of an updated return is just 2 years from the end of the assessment year. And therefore, all the probabilities which were available for filing of an updated return in case of search, requisition, etc., all the years have been blocked. Now, for none of the years, we can file the updated return, which was otherwise possible for that assessee to submit under this new provision of subsection 8A of 139. Further, this restriction on filing of this updated return will apply not only to that person in whose case this action has been taken, but also to other persons to whom a notice has been given that, look, the search or survey, etc., had been conducted in someone else's case, but some books or assets, etc., have been found which are belonging to you, or they are related to your case. So to give you an example, if the search has been conducted at my place, the restriction on filing this updated return will apply to me, as well as if some assets belonging to you or your books, etc., or some documents, etc., have been found wherein some information inside those documents are related to your case, and department has issued a notice to you Stating all this, then in that case, the restriction on filing of this updated ITR for 3 years will apply to you as well and not only to me. So this is the restrictions applicable on filing of this updated ITR in case of search, survey, etc. What is the timeline available for filing of an updated return? As I already mentioned to you, that is updated return can be filed within a period of 24 months from the end of that relevant assessment years. So 2 years have been given for filing of an updated return after the end of the assessment year. And these provisions of subsection 8A of section 139 are effective from 1st of April 2022. Please note that, friends, I'm referring to an effective date as 1st of April 2022. I'm not saying that this is effective from assessment year 22-23. There's a point which is arising from this effective date of the amendment, which will be discussed in the subsequent slides. So before we move on to some other sections which are dealing with this payment of tax, etc., upon filing of an updated return, what are the important points which are arising or important issues which might arise from this new provisions of subsection 8A of section 139? We can understand the position of this provision for filing of an updated return by dividing these cases into 2 different categories. The first category is a case where that person was a non-filer otherwise, he had never filed his ITR earlier, and now he is filing this updated ITR, which becomes his first ITR for that assessment year. Now that person is allowed to file this updated ITR subject to all those restrictions which we discuss of initiation of assessment proceeding or having information or search, survey, etc. Subject to this, assuming that none of these restrictions are applicable. In that case, that person can file this updated ITR except for cases where he is declaring a loss in that updated ITR or he is claiming refund in that updated ITR, subject to these 2 restrictions. So these are the restrictions vis-a-vis the end result of this updated ITR. So what is happening in this case is that person was a non-filer of ITR otherwise, and now by filing updated ITR he is claiming some benefits. What are the benefits he is claiming? He is claiming a benefit of a loss, or he is claiming a refund of some amount out of prepaid taxes. And therefore, since I have already mentioned to you that this proposal is meant for the benefit of the revenue, benefit of the IT department, not for the benefit of the taxpayers, and therefore in this particular case that person will not be permitted to file the updated ITR at all. The second category is a case where I have already filed my ITR earlier, but for some or the other reason I want to file my updated ITR now. Now here I can file my updated ITR only if there is an upward revision in my amount of income. If there is a downward revision in my amount of income, I cannot submit this updated ITR. That's a concept. Now the question over here is that whether for the purpose of applying this restriction, whether I need to see the net impact of all the changes which I'm making in the updated ITR, or I need to see on a transaction to transaction basis. What do I mean by this? That, for example, I had already filed my ITR. There was one particular transaction which had been executed by me in that year, and I had offered an amount of income of 10 lakhs from that transaction. Now, today I realize that there were several errors. The first error was that amount of income from that transaction which was offered to tax at 10 lakhs rupees was wrong, and my true amount of income was just 8 lakhs. I want to reduce that amount of income by 2 lakhs. I also found that I had some second transaction which was also executed in the very same year, and there was an income of 5 lakhs of rupees which was earned from that second transaction, which had been completely missed out when I filed my ITR earlier. So I have 2 errors. One of the error is resulting into a reduction of income by 2 lakhs, and another error is resulting into an increase in income by 5 lakhs. And the net impact of this is increase in my taxable income by 3 lakhs. Now, can I file my updated ITR rectifying both of these errors? To my mind, the answer to this question is yes, is because what we need to consider is the net position. As long as the net position is not resulting into a decrease in the tax liability on the basis of my earlier ITR, this provision allows me to file the updated ITR, and therefore I would like to see the net impact of whatever changes which I'm making in my updated ITR. The second is, what if I had already filed my ITR and I had declared some amount of loss in that ITR which was already filed by me under the regular provisions of section 139. And I found some mistakes, some errors, and because of which now I want to file the updated ITR, reducing the amount of loss declared. I am reducing the amount of loss, friends, and therefore, in a way, this is resulting into some benefits for the department. It is not for my benefit. Now, can I submit my updated ITR in this particular scenario? The answer to this particular question upon literal interpretation of the provision is no, because there is a restriction which says that as long as there is a loss which is declared in the updated ITR cannot be submitted. It doesn't say that if you are reducing the amount of loss which was already declared by you in the earlier ITR, then you can file the updated return. The provision is not specifying or clarifying this. And therefore, as long as there is a loss which is declared in the updated ITR, filing of updated ITR seems to be not possible. One more point in support of this particular conclusion is that mechanism for payment of additional amount of income tax is also not provided in this particular scenario, and therefore it appears that updated filing of updated ITR seems to be not possible in such a scenario. There is a restriction which says that if the assessment has already been initiated or completed, you cannot file the updated return. And when I mentioned that particular restriction, I'll go back to the slide. It refers to an assessment or reassessment or recomputation. Now, when I'm referring to the word recomputation, the issue which is arising here is that whether processing of ITR under section 143(1) can that be considered as a recomputation? And if that is the case, once my ITR is processed under 143(1) and I have been given an intimation by CPC, does it mean that now I'll never be able to file my updated ITR? The answer to that question is no. Is because the word recomputation, which is used here for the purpose of applying that restriction, should be construed with reference to the provisions of section 147. If you read section 147, it also uses the similar word assessment or reassessment or recomputation. And therefore, it is in that context the word recomputation seems to have been used over here. And therefore, merely CPC is recomputing your income in an intimation under section 143(1) cannot be considered as a restriction now applicable for the purpose of filing of your updated ITR. If a prosecution has been initiated under any provisions of the Act, the restriction on filing of updated ITR will apply. Now, this is something which is illogical. Even in a case where the prosecution is initiated for the purpose of offense committed in complying with TDS provision, which has nothing to do with assessment of my income or a filing of ITR in my own case, but still, once the prosecution has been initiated under any provisions of the Act, you are not permitted to file the updated ITR. Now, in any case where the option is still available for you to file a belated ITR or a revised ITR within the time limit which is available under section 139, or because of extension of that time limit, then obviously that person should prefer filing of belated or revised ITR first, instead of just going directly for the purpose of filing of updated ITR. Now, when I talked about the time limit for filing of an updated ITR, friends, is just talked about the outer time limit. It doesn't say that this updated ITR can be filed only after the end of this time limit available for this filing of the belated or revised ITR. But this is an obvious point which one should consider, that as long as I have an option to file my updated, the belated or revised ITR, I should first exhaust all the options which are available to me, and then only if no other option is left, I can think of filing of an updated ITR. The question is that whether updated ITR can be filed for assessment year 2021 after 1st of April 2022. So when I was just referring to the effective date of this amendment, I made a reference to the date of 1st of April 2022 and not as assessment year 2023. So it implies that this amendment is not effective from AY 22-23. It is effective from 1st of April 2022. And therefore, perhaps even for the prior assessment years, as long as the time limit of 2 years is available. So if we are talking about assessment year 2021, the time limit of 2 years will expire on 31st of March 2023. And therefore, probably that person can file that updated ITR even for assessment year 2021 after 1st of April 2022. That is the date on which the provision will come in effect, but with the condition that there should be an option available on the portal. Okay, so portal needs to be redesigned, enabling this option of filing of an updated return. Today we are living in an era where the law will provide for a provision, but CPC is a king, or probably that portal is a king, system is a king, and they are going to decide how this provision should be made applicable. So as long as the option is available on the portal, technically speaking, that update filing of an updated ITR, even for assessment year 2021, should be possible under this proposed amended provision. The question here in my slide is that whether I can file my updated return even in a case where I'm not changing my tax liability at all. I'm not offering any additional amount of income. I'm not going to pay any additional amount of a tax liability. When I just made a beginning of explaining this provision, I just explained the concept that as a concept, the updated ITR is for increasing the income or for offering the additional amount of tax. That's just a concept. But if you read the provision, it says that you can file the updated ITR except for these cases, and the cases listed there are that you are filing an updated ITR which is resulting into a reduction in the tax liability. There is no restriction in a way which says that you cannot file an updated ITR if you are not offering any additional amount of income. The provisions are not worded in that manner. And therefore, the question here is that whether the person is allowed to file an updated ITR even in a case where he is not changing his amount of income, and as a result, the amount of tax liability at all. Now, you might be thinking that what is the need of filing of an updated ITR in such a case? There could be several cases. So, for example, that I want to modify some of the information which I have already filed in my ITR, which has gone wrong. So, take a typical example of cooperative societies, where CPC is now, while processing the ITR, in majority of the cases, they are denying the deduction which has been claimed under Section ATP. One of the common reasons for denial of this deduction under Section ATP is that there is a condition for claiming this deduction under ATP is that the society should have filed this ITR on or before the due date, regular date which is applicable for the purpose of filing the ITR. Now, while filing the ITR for the society, if you don't mention that the audit is applicable to that society, either under Income Tax Act, or if not under ITA, but at least under the respective Cooperative Societies Act, then in that case, CPC on its own will not be able to decide that for this society, the auditing is applicable and therefore the due date is 31st of October and not 31st of July. So if this information is not provided while filing the ITRs of the societies, CPC will be considering the due date as otherwise applicable to non-audit case, and therefore if the ITR of that society was filed after that due date which is applicable to a non-audit case, but before the due date which is applicable to an audit case, technically for CPC, this ITR becomes a belated ITR. And therefore, the deduction which has been claimed under Section ATP will be denied. Now, what can be done in this kind of cases? You can explore the possibility of rectifying your return under Section 154, but I have been told that even in this cases, the rectification is also not possible. And therefore, perhaps you can explore the possibility of now filing an updated ITR without changing the income, without changing the tax liability, but by just including some of the information or for rectifying some of the data which has gone wrong in the ITR which has already been filed by you, or you want to make certain disclosures. So there are several disclosures which are required to be made in the ITR. For example, disclosures related to foreign assets and foreign income. If there is a default in disclosing this information, there are heavy penalties which are prescribed under the applicable acts. And therefore, if you want to avoid all those penal consequences, and if you want to disclose this data which were not earlier disclosed, probably that person can explore the possibility of filing of an updated ITR, which according to me should be possible. This option cannot be denied to that particular person who is just proposing to change some of the important information within this ITR, though he is not declaring any additional amount of income or additional amount of tax liability. So with this understanding of subsection 8A of section 139, I'll proceed further. A new section 140B has been inserted, which is a supporting provision. Today we have section 140A, which provides for payment of self-assessment tax upon filing of this regular ITR. And now for filing of updated ITR, we have a new provision, section 140B, which provides for payment of several amounts, which will include tax, interest, fees, and additional amount of tax. So first, let me explain the concept of payment of additional amount of income tax. So section 140B provides that the persons who are filing this updated ITR will have to pay additional income tax at a given percentage. And this additional amount of income tax is required to be computed at the given percentage of the aggregate amount of tax as well as interest which is payable while filing the updated ITR. So what I'm supposed to do is that if I want to file the updated ITR, I'll be first computing what is the additional amount which I'll have to pay in the form of tax and interest under several provisions of the Act. Because of this filing of updated ITR, I'll take the total amount of tax and interest. And when I'll be taking this total amount of tax and interest, of course, I'll be including all types of surcharge and cess, whichever is applicable to me, depending upon my amount of income. And then on this total amount, I'll apply this percentage which has been provided in section 140B. By applying the specified percentage, I'll be computing the additional amount of income tax. And this additional amount of income tax is also payable while filing this updated ITR. Now, this additional amount of income tax is payable at 25% or 50% of the sum total of tax and interest, depending upon when you are filing this updated ITR. If you are filing your updated ITR within the first year of from the assessment year, in that case, you are supposed to pay just 25% of total amount of tax and interest. So I've given an example, friends. If you are talking about a case of assessment year 22-23, if I want to file an updated ITR for assessment year 22-23, then till 31st of December 22, I have an option of filing my belated return or a revised return, whatever I want. And therefore, effectively, one would be exploring this option of filing an updated ITR only after 1st of January 22. So if you are filing an updated ITR within those 3 months, that is January to March of that same assessment year, or within a period of 1 year after the end of the assessment year, that is up to 31st of March 24, then you will be penalized by just as the 25% of the total amount of tax and interest. So you need to pay 25% of the total liability of tax and interest. But if you are filing updated ITR even after 31st of March 24, that means you are filing updated ITR in the second year. In that case, you will be penalized at 50% of your total liability of tax and interest. So that is how one will have to compute the amount of additional income tax at 25% or 50%, depending upon the year in which you are filing this updated ITR. Now, having understood this concept of payment of additional income tax, now let me go back to the concept of payment of normal amount of tax liability as well as interest and whatever fees if they are applicable to me. So for the purpose of this computation of tax, interest and fees, you might be wondering as to what we need to understand as far as this computation of tax, interest and fees, which we are doing from since years. But friends, there are a lot of complications even in the computation of basic amount of tax liability, interest, etc. when we are talking about this concept of filing of an updated ITR, and therefore we need to understand this in more detail. So section 140B, we have been given two subsections, subsection 1 and subsection 2. All the cases of filing of an updated ITR have been divided into two categories. The first one, that is subsection 1, is a case where I was a non-filer otherwise, and now I am filing the updated ITR, which is my first ITR for this assessment year. And subsection 2 is a case where I had already filed my ITR earlier, and now I am filing this updated ITR in order to rectify some of the mistakes or errors in that ITR which had already been filed by me. So the first case, a case of a non-filer, I have given this computation of tax and interest in this first slide, and then we'll try to understand the second category in the subsequent slide. So here, friends, we need to compute the amount of tax liability and interest under section 234 A, B, C, whatever is applicable to me depending upon that case. And this tax and interest here is a simpler one, which I'll be computing in a normal manner in which otherwise I'm supposed to compute as if I'm filing my regular return of income. There are no much complication as far as this computation of tax and interest is concerned. I'll be then taking a sum total of this tax and interest under all the provisions 234 ABC, whichever is applicable to me. And on sum total of this tax and interest, I'll be adding the additional income tax, which will be at 25% or 50%, depending upon in which year I'm filing this updated ITR. And then further, I'll have to also add the amount of fees which is applicable to me under section 234F for defaulting furnishing my return of income. So since here we are talking about a case of a non-filer where I had never filed my ITR earlier, and now I'm filing this updated ITR as my first ITR, of course, that fees for late filing of ITR under section 234F is applicable to me, and therefore I need to add even that amount of fees as applicable to me under section 234F. So I'll be paying tax, interest, additional income tax, and fees. All this 4 types of payment. The second is a much complicated scenario, a case where I had already filed my ITR, and now I am again filing my ITR in the form of an updated ITR under this new provisions of subsection 8A of section 139. Here also I need to pay the tax, interest, additional income tax. We will not be talking about payment of fees is because here is a case where I had already filed my ITR earlier. So it is depending upon whether I had filed my original ITR within the due date, after the due date, etc. Whatever fees which are applicable to me otherwise under section 234F, I must have already paid that amount of fees. If not paid, CPC must have already charged that amount of fees to me while processing the return. And therefore, now we are once again not concerned with the payment of additional fees under section 234F for default in furnishing of return, at least in this scenario. So when now we are talking about computation of tax first, we need to compute the amount of tax payable at the time of filing of an updated return in a manner where what I'll be doing is that I'll be computing my tax liability otherwise on total amount of income which is declared in my updated ITR is very simple. Then I'll be reducing my gross tax liability by all types of credits, TDS, TCS, advanced tax, etc., which I've already claimed in my earlier ITR. And then further, I am allowed to claim the tax credits, new tax credits, advanced tax, TDS, whatever tax credits, while computing this amount of tax payable upon filing of the updated ITR, but it is subject to a condition. And what is that condition? The condition is that whatever credits, new credits which you are now claiming, the credits which were not claimed by you in the earlier ITR, and now you are claiming them in the updated ITR for the first time, you are allowed to take this additional credits or new credits subject to the condition that corresponding income, underlying income should have been offered by you in this updated ITR for the first time. I hope you have understood this condition. It implies that the corresponding income was already included in your earlier ITR, which you had already filed, but the TDS credits, etc., with respect to that amount of income had not been claimed. They were missed out while filing the earlier ITR. Now you cannot claim this credits while filing this updated ITR. That is not the option for you through this updated ITR. You can explore whatever other options are available to you, including condonation of delay for filing of that refund claim or belated or claiming the TDS credits, etc., under section 119, where CBDT has provided that circular. But under this provision for filing of an updated ITR, you cannot claim those credits. So for claiming additional tax credits which had not been claimed in the earlier ITR, there is a condition which is imposed upon us that the corresponding income should have been offered by you for the first time in this updated ITR. Then further, we have to increase this amount of tax liability by whatever amount of refund which has already been granted to you as a result of earlier ITR which was filed by you. It's quite logical that now, since I am revising my whole computation of income, and we are starting this computation of liability to pay the tax with respect to the gross amount of tax liability, whatever refund which was already claimed and granted to you, you will have to add this amount of refund to this whole computation, and total amount is required to be paid by you. Now coming to interest, we have interest under 234 A, B, and C. As far as this interest under 234A is concerned, I have put a question mark there, which I'll be discussing. There is an issue which is arising as far as this interest liability under 234A is concerned. I'll be discussing that in the subsequent slide. Interest under 234C is required to be computed in a normal manner. There are not much complication which is arising as far as 234C is concerned. 234B is also required to be computed in a normal manner, but there's one catch there. When you are computing now interest under 234B, generally what we do is that we compute interest under section 234B with respect to a shortfall amount. So we take total amount of tax liability and then we reduce by whatever advance tax which has already been paid. So it is for that shortfall in payment of advance tax. Now here, when we are computing this interest under section 234B for the purpose of updated ITR, we are asked to compute this interest on a total of that shortfall plus whatever refund which has already been granted to you. So you have to take a sum total of these, and on this sum total, we will have to compute the interest under section 234B. That is the point which is required to be noted as far as this computation of interest under section 234B is concerned. And then total amount of interest will be reduced by whatever interest which is already paid by you while filing your earlier return. And it is only a net amount of interest which is required to be paid along with this updated return. And now the additional tax will be computed at 25% or 50%, depending upon the year in which you are filing your updated return. And this percentage will have to be applied on a sum total of this tax and interest liability. And friends, please note that this 25% or 50% is not required to be applied on the gross amount of tax or interest liability. This is required to be applied on the net amount of liability. So whatever is the net amount which becomes payable by you for this tax and interest, it is only on the net amount this 25% or 50% is required to be applied for the purpose of computing this additional amount of income tax. Now, as far as this interest liability is concerned, we have been told that you have to compute interest under whichever section which is applicable to you, whether it is A, B, or C. You have to compute this interest by taking the total tax on the revised amount of income. For the purpose of interest, now you cannot go back to your original amount of income because now you are filing your updated ITR, revising your amount of income, and therefore interest will also be computed on the revised tax to be computed on the revised amount of income. 234B and 234C provisions, 234A and 234B provisions have been amended to provide that now while computing this interest under section 234A and B, when you take the base amount, that is a tax amount on which you are computing this interest, this tax amount will never include any additional amount of income tax which is payable, which is 25% or 50%, whichever the case may be, while filing this updated ITR. I hope I'm clear on this particular concept. If I go back to the previous slide, we have been told that, look, when you are computing additional income tax, 25% or 50%, you need not include this additional income tax when you are computing your interest under section 234 A, B, and C. Otherwise, what will happen? It will result into a circular reference. Why circular reference? Circular reference is because if interest needs to be computed on the total tax, that is tax plus additional income tax, but additional income tax is 25% or 50% on sum total of tax and interest. So both the amounts are dependent on each other. It will be resulting into a circular reference, and therefore that error of circular reference has been avoided by making a specific provision under 234A and B by providing that additional income tax need not be included while computing your interest liability under 234A, B, or C. There are a lot many issues which are arising as far as this computation of liability is concerned. The first one, I had raised that question mark as far as the interest under section 234A was concerned. And why I was raising that question mark is because if you read subsection 2 of 140B, it is making reference only to the interest liability which is payable on account of shortfall in payment of advance tax or deferment in payment of advance tax. It is not referring to the interest liability for defaulting furnishing the return of income. So in a case where this issue I am discussing only in a case where ITR was already filed. If you are a non-filer, you are filing updated ITR for the first time, invariably 234A interest is required to be paid. But if I had already filed my ITR earlier, and the earlier ITR which I had filed was a belated ITR that was filed after the due date, and now I'm filing further updated ITR, increasing my tax liability. The question here is that 234A liability, which I must have already paid earlier along with my original return, do I need to revise my interest under section 234A on the basis of now revised tax liability, which I am now offering in the updated ITR? If you read 140B subsection to a new provision which has been inserted, it is not coming out very clearly, but I'm sure that when CPC will be processing your ITR, CPC will be recomputing your interest liability under section 234A on the basis of revised amount of income which you are now offering in the updated ITR. Another issue under section 234B is, I have already mentioned to you that 234B interest is required to be computed on a sum total of shortfall as well as the amount of refund which has already been granted to you. So here the reason is that since that refund was granted to you, which was a wrong refund, because now you are revising your income, you are offering additional amount of income and a tax liability, and therefore as a compensation, the interest is also charged under section 234B even on that amount of refund which was granted. But the problem, friends, here is that 234B interest computation, we know that the period for which the interest is to be computed is right from 1st April of that assessment year. Whereas the refund which is granted to me, obviously refund will never be granted to me on 1st April. So consider a case where the refund is granted to me on 1st of December of the assessment year, but I am asked to compute the interest on this refund amount right from the 1st April of that assessment year. So though for those 8 or 9 months, whatever the case may be, I have not enjoyed that amount of refund, I'm still asked to compensate the government by computing and paying the interest liability under section 234B right from the 1st April of the assessment year. So perhaps there's a need to reconsider this particular provision as far as this computation of interest is concerned. Interest under section 234C. So when I was on this slide, I just made a reference that there is an amendment only in 234A and B to avoid that circular reference. Now, does it mean that in the absence of any amendment under 234C, whether while computing this interest under 234C, whether I need to include the amount of additional income tax? There is no clarity on this. Perhaps they have missed out making an amendment in 234C. Otherwise, if you are asked to compute interest under section 234C on the total amount of income tax as well as additional income tax, we will be facing the same problem of circular reference. It is quite illogical to ask that person to compute interest under section 234C on the total amount of tax as well as additional income tax. Just one more point before we end this discussion and before we move on to the next set of amendments is that it is not a precondition that updated ITR should always result into a payment of additional income tax. I'll just give you an example to understand this. Just look at this example. I had already filed my ITR earlier. I had declared an income of 10 lakhs. On this income of 10 lakhs, there was a tax liability of 3,12,000 which was computed. There were total prepaid taxes aggregating to rupees 8 lakhs, and therefore I had claimed a refund of an amount of around 5 lakhs of rupees. To be precise, 4,88,000. Now, this is a case where though I had claimed a refund, that refund was not granted to me yet. Before this refund is granted to me, now I'm filing my updated ITR. And I'm adding the amount of 2 lakhs to my income, which was declared in the original ITR. And therefore, correspondingly, it results into increasing my tax liability. The prepaid taxes remains at the same amount of 8 lakhs. And now I am claiming a refund of around 4,25,000. So I am reducing the amount of refund claim. Question number 1. Am I permitted to file the updated ITR in this case? The answer to this question is yes, because the restriction is applicable in a case where I'm increasing the amount of refund claim, but here is a case where I'm reducing my amount of refund claim. I was claiming a refund of 4,88,000 earlier, and now I'm reducing my refund claim to 4,25,000, and therefore obviously I'm permitted to file the updated ITR. Question number 2, do I need to pay any additional income tax? The answer to that question, as it appears today, is no, is because additional income tax is to be computed at given percentage on the total of tax and interest payable. Now here in this example, whether any tax is payable in this case, answer is no, is because I have already prepaid taxes which is sufficient enough even to cover my additional tax liability which is arising due to this updated return, and still it is resulting into a refund. And therefore, in the absence of any tax liability which is becoming payable, additional income tax, the computation mechanism fails, and therefore additional income tax is not becoming payable at all in this particular case. There are few consequential amendments which have been made, which says that best judgment assessment which could have been made in the absence of ITR. I mean, in a case where that person has defaulted in filing of his ITR, now that cannot be made if that person has filed the updated ITR. So assessment will have to be now made with respect to the whatever information which is available in the updated ITR. The time limit to complete the assessment is extended in a case where that person is filing the updated ITR. This was needed because otherwise, in the absence of this corresponding extension in the time limit of the assessment, it might be possible that the person is now filing updated ITR subsequent to completion of the time limit of the assessment. And therefore, now it provides that if the updated ITR has been filed, the assessment time limit to complete that assessment would be 9 months from the end of that financial year in which this updated ITR has been filed. And the last one is from prosecution. The prosecution will not be initiated for an offense of non-filing of ITR under section 139 if the updated ITR has been filed. So this is something which is in benefit of the SSC in a case where you are a non-filer and there's a probability that prosecution might be initiated against you for non-filing of a return or an offense under section 139. In that case, you can come forward, file your updated return, and moment you file your updated return, this amendment provides that now you will not be prosecuted at all. This exemption from prosecution is applicable only for an offense of non-filing of ITR under section 139. If there is an offense which is committed for non-filing of ITR under some other provisions, so for example 148, that can continue, which has nothing to do with this filing of an updated ITR. So with this, I have completed the discussion on filing of an updated ITR. Before I move on to the next set of amendment, just one point to conclude is that the question which is arising over here is that whether this amendment which has been proposed allowing the taxpayers to file the updated ITR, will that amendment will be a non-starter provision? The question is that whether the taxpayers would like to avail this benefit which is available to them to make a voluntary compliance by filing an updated ITR. Just consider a simple case. Why I'm raising this question is that because this is subject to the condition that you have to pay 25% or 50% of the total amount of tax and interest. So that is an additional burden which that taxpayer will have to bear if at all if he is deciding to file the updated ITR. Consider a simple case that where I had already filed my ITR and some income has been omitted, has not been offered to tax in my earlier ITR. And now I'm evaluating two options, whether I should file the updated ITR or I should leave it and I should just see what are the consequences if at all I am being assessed. When I'm presenting this comparison to you friends, the objective is not to criticize this amendment, but just to make that position very clear that whether asking that taxpayer to pay 25% or 50% of total amount of tax and interest, whether that is justified or not, that is the objective of this comparison. So if I am filing my updated ITR, you know the consequences that I'll have to pay the tax and interest plus 50% or 25% of this total of tax and interest. But in comparison of this, if I don't file my updated ITR and if I am being assessed, the department is having that information that this income which was required to be offered by me, I have not included in my ITR and I have not paid the tax on that particular income. Now, if I am being assessed, what will happen? Consider that this is just a simple case of an under-reporting of an income, and this is not a case of a misreporting of an income. If this is a case of a misreporting of an income, the comparison would be different, the outcome would be different. So if it is a simple case where it might result into a mere under-reporting of an income, and if I am assessed, what will happen? I will have to pay the differential amount of tax, which is in any case payable if I am filing updated return. I'll have to pay interest under 234 ABC, whatever is applicable to me, which is also applicable in an option of filing an updated return. If I am assessed, then I am running a risk of getting penalized under section 270A. Now, if I'm penalized under section 270A, the penalty amount is 50% of the tax on underreported income if there is no misreporting of income. Now compare this with the additional liability of income tax, which is payable under section 140B. 140B is also providing for the highest liability, which is 50% of that amount, and penalty is also 50% of that amount. But what are the differences? Under 140B, I have to pay additional income tax, which is 50% of total amount of tax and interest, both of this. Whereas that penalty under section 270A is just 50% of only tax amount, not tax and interest. So effectively, for updated return, my rate of interest is increased from 1% to 1.5% for all practical purposes. So my total outgo, if I'm exercising that option of filing an updated return, would be slightly higher because of that difference. That is not the end. In case if I am assessed and if the penalty proceedings are initiated under section 270A, then I have an option of filing a form under 270AA and ask for that assessing officer to give me an immunity from levy of a penalty. So if I satisfy certain conditions, that option is always available to me. And if I have been granted that immunity from levy of penalty under 270AA, I will not be penalized at all. Whereas in case of an option of filing an updated return, I don't have that option. I will have to mandatorily pay that amount of additional income tax, without which I cannot proceed for filing of an updated return at all. So this is, a comparison which I thought that I should share with you. The comparison would be totally different, as I've already clarified that if this is a case where there is a misreporting of an income, where the penal consequences would be quite higher as compared to whatever we have discussed just now. So with this, friends, I'll move to the next set of amendments dealing with virtual digital assets. But before that, if you have any questions with respect to updated return, I'll be happy to answer those questions. So is everything, Parin, everything is clear so far? The screen and my voice?
Yes, sir. Only thing is, one question was there in the chat box to give highlights on processing of updated ITR, how it will be considered by the department.
If you're filing updated ITR, that will go to CPC, and CPC in a normal manner process your updated ITR even under 143(1). You will be sent intimation. And if further required, that case can be selected for scrutiny under 143(2). It is not mandatory that you will always be assessed once you are filing an updated ITR. Whatever other consequences which might follow if you are filing a normal return will also apply even in case of an updated ITR. There is no difference otherwise. It becomes a normal return under section 139. So with this, I'll proceed to discuss the provisions related to virtual digital assets. So since that updated ITR was a very important provision, I thought that I'll be discussing that first, and I'll be spending reasonable time for discussion of updated ITR. Now I'll just try to quickly proceed with the other amendments. So the amendments dealing with taxation of VDA, that is virtual digital assets. So now the finance minister is eating this bitcoins by levying tax at 30%. So the first amendment is insertion of a definition of what is the meaning of virtual digital asset. A clause 47A has been inserted in section 2. Friends, I will not be discussing this definition because it is highly technical even for me. We need a technical person to explain as to what is the meaning of this virtual digital asset as defined under the Income Tax Act. But just few of the points which are coming from that particular definition is that in order to regard any particular asset as a virtual digital asset, the definition is such that it should be possible for that person to transfer, store, or trade in those assets electronically. That is a condition which is required to be satisfied. Further, it says that any other digital asset can be notified by the government in order to make that digital asset as a virtual digital asset. So we have this definition, and now we'll move on to the next amendment, which is an insertion of new section 115 BBH, which will be applicable with effect from assessment year 23-24. Now, here in section 115 BBH, friends, we are talking about the calculation of a tax liability from the transactions of VDA. We don't have any amendments as to how do we compute the income arising from VDA under any of the provisions with respect to 5 heads of income. So I'll come to that point little later, but first let us try to understand this new section 115 BBH. This section will apply in a case where the income of that person includes the income, total income of that assessee includes any income from transfer of any VDA. So the precondition in order to apply this provision is that there should be an income arising from transfer of any VDA. In that case, this provision will apply. Otherwise, this provision will not apply at all. So keep this particular point in your mind, that there has to be some income which is arising from transfer of any VDA in order to apply this particular provision. So if this provision is becoming applicable, in that case, while computing your tax liability, you will have to calculate the tax at 30% on this amount of income, that is income arising from transfer of VDA, and rest tax liability will be computed as per your other normal provisions, whichever is applicable to you. So the meaning of this provision is that your income arising from transfer of VDA now will be computed, now will be taxed at the rate of 30%. Further, it provides that while computing this income arising from transfer of VDA, you will not be granted any deduction of any expenditure or allowance. You will be granted deduction only of your cost of acquisition. Okay, so cost of acquisition is also nothing but an expenditure, and therefore cost of acquisition is allowed to be reduced. But apart from this cost of acquisition, no other deduction of any other expenses or allowance. You will also not be granted any set off of losses under any provisions against this income arising from transfer of VDA, as well as if you have incurred a loss from transfer of VDA, you are not permitted to claim a set off of this loss against income under any other provisions of the Act, and you will also not be allowed to carry forward that loss. The restrictions is applicable on both the sides. The first one is on an inward adjustment. If you have a positive income from VDA, you can't set off the other losses. The second restriction is on an outward adjustment. If you have a loss from VDA, you cannot set off this loss against any other income, as well as you cannot carry forward this loss also to the subsequent year. So what are the important issues which are arising out of this? That though we have been told under 115 BBH that you will be charged with a tax liability of 30% on this income arising from transfer of VDA, but in Finance Bill 2022, we don't have any amendment which is providing for the head of income under which this income is required to be computed. That means we will have to compute the income from VDA as per the normal provisions which are applicable to me. So the question is that whether someone can treat this VDA as a capital asset, and if other facts of his case supports that he is an investor and he is not a trader into this bitcoins, etc., can he compute this income as capital gains? The answer, it appears that yes, it is possible for someone to claim, because virtual digital assets are nothing but assets. And every asset can be considered as a capital asset subject to those exceptions of stock in trade, etc. And therefore, it is possible for someone to claim that VDAs are also nothing but my capital assets, and therefore income arising from transfer of VDA is also nothing but my capital gain. If you are computing capital gain, whether cost of acquisition can be indexed, and can I reduce my indexed cost of acquisition? The answer to this question is a little trickier, but it appears that the provision allows the deduction of only cost of acquisition and not the index cost of acquisition, and therefore perhaps we will have to ignore the benefit of indexation while computing the capital gain upon transfer of this VDA. If those VDAs were held for more than period of 36 months, and therefore the resultant capital gain is a long-term capital gain, Section 112 provides that this long-term capital gain will be taxed at 20%, but now 115 BBH provides that this income from VDA will be taxed at 30%. The question is that which one will prevail out of these two? Perhaps since 115 BPH is a more specific provision dealing with income from transfer of VDA, that should prevail over section 112. That is how I understand probably. When it provides for a restriction on set-off of losses from VDA transactions against other income, the question is that what if I have multiple transactions in VDA itself? So in one transaction of VDA, I have incurred a loss. In other transaction of VDA, I have earned some profits. Now, whether I can set off this loss from one VDA transactions against the gain from another VDA transactions, whether that can be done, or whether that restriction will apply that loss arising from VDA transfer of VDA cannot be claimed as a set off. To my mind, this inter se adjustment should be something which should be permissible. It is only when the net result of all VDA transaction is a loss, one will have to forget that loss. No benefit of loss can be claimed either in the form of set off in the same year or in the form of a carry forward of that loss to the subsequent year. There is no provision in this new section to tax the income from VDA on the basis of fair value of VDA. So we have provisions like 50CA or 50C, which provides for a fair value mechanism, and therefore we are taxed on the basis of higher of actual consideration or a fair value of those unquoted shares, etc. But here we don't have any such provision. We have another amendment in section 56 related to VDA. Section 56 to 10 provides for taxability of receipt without consideration. And here it provides not only for receipt of money, it also provides for receipt of an immobile property or some other specified movable properties. And for that purpose, the term property has been defined in an explanation in which provides for assets like shares or securities or bullions, etc. Now that definition of property has been amended, and the virtual digital assets is also included in this list of specified properties for the purpose of 56 to 10. What is the meaning of this? What is the implication of this now? Is that any person who is receiving VDA without consideration or for an inadequate consideration subject to that threshold of 50,000 will now be taxed under section 56 to 10, subject to the exceptions which are applicable, like for receipt from relatives or received on certain occasions, etc. This amendment is effective from assessment year 23-24. Now, what are the important points which we need to note out of this simple one-line amendment in section 56? The first one is that since we are talking about applicability of this amendment from assessment year 23-24, does it mean that receipt of VDA without consideration or for inadequate consideration in the prior assessment years prior to 23-24 will not be taxed under these provisions of 56 to 10? The answer to that question is that yes, it can't be taxed, is because now the term property has been defined to include VDA, and that too only with effect from 23-24. And therefore, in the prior assessment year, at least 56 to 10 cannot be invoked with respect to the receipts of VDA. Other provisions of the Act like 68, etc. might be invoked if those conditions specified in these other provisions are satisfied, but at least 56 to 10 cannot be invoked. Since we are talking about taxability under 56(2)(a), we need to have the value of this bitcoins, etc. And therefore, these valuation rules will have to be modified very soon in order to provide a mechanism as to how do we value this virtual digital assets for the purpose of taxability under these amended provisions of 56 to 10. This income which is now getting taxed because I have received this VDA for without consideration or for inadequate consideration, friends, this income will not be taxed at 30% under 115 BPH. 30% rate of tax as provided under section 115 BPH will apply only if there is an income which is arising from transfer of VDA. Here, we are talking about an income which is arising from receipt of VDA without consideration or for an inadequate consideration. And therefore, certainly the same income which arises from receipt of VDA cannot be considered as an income arising from transfer of VDA. And therefore, this income under section 56 is required to be taxed as per the applicable rates to that SSE, but not at the rate of 30% as provided under section 115 BPH. The last provision dealing with this VDA is a TDS mechanism under section 194S. A new section has been inserted, which is 194S in this TDS provision, which now provides for a deduction of tax at source. by the person who is paying that consideration for transfer of VDA to him. So what is this new provision under 194S? The person who is responsible for paying a consideration for transfer of VDA to any person is that person is now required to deduct tax at source at 1% of this amount of consideration. The only exclusion is that where that payee is a non-resident, you are not going to apply this TDS under 194S. TDS under other provisions like 195, etc. might apply, but TDS under 194S is not applicable. So since 194S is inserted in that series of all other sections like 194A, etc., which are also applicable only when a payee is resident, here also, for the purpose of applying this TDS provision, that payee should be a resident person. Payee cannot be a non-resident person. TDS is required to be deducted at the time of credit of that consideration or payment of that consideration, whichever is earlier, something which is similar to all other TDS provisions which are applicable. Further, this new section 194S provides that in a case where the consideration which you are paying for transfer of VDA to you is a consideration which is in kind, or if there is a transaction wherein one VDA is exchanged for another VDA. So for example, I am holding some Bitcoins, you are holding some other tokens, etc., which are falling within the definition of VDA, and both of us are exchanging this VDA internally. I am giving my Bitcoins to you, and in exchange, you are giving all other such VDAs which are available with you to me in consideration of this. So in a case where the consideration which I am supposed to pay for transfer of VDA to me is not in cash, basically, it is in kind, or it is an exchange of one VDA by another VDA. Now here the difficulty would arise in applying this TDS provision is because I don't have sufficient cash component here from which I can deduct this tax at source. For the purpose of deducting tax at source, I need to have some monetary payment, and then only I can deduct tax at source. And therefore, considering that this difficulty might arise, we have been told under this new provision, and in that case, the person responsible for paying this consideration in kind, you will have to ensure that the tax has been paid in respect of that consideration for VDA. And that too, before you release this consideration. What do I mean by this provision? Friends, this provision is something which is similar to present provision which are there under section 194B, which are applicable in a case where this winning, etc. has been given in kind. There also similar terminology has been used. And therefore, in this case, what I am supposed to do is that if I am paying consideration which is in cash, I should deduct TDS if my cash consideration is sufficient. If the cash consideration is not sufficient, or that transaction is a complete transaction where I am paying consideration in kind, in that case, I need to ensure that the tax which is payable on that consideration which is received by that payee has been paid, and that too before I release that consideration. A harsh provision it appears, but we'll be discussing some more points in the subsequent slide. Further, we have been told that this 206AB, etc., where I am required to deduct TDS at a higher rate due to a non-filer case, etc., won't apply in this case. If TDS under 194S is applicable, that is a new provision, then TDS under all other provision, including TDS on e-commerce operator under 194O also will not apply. TDS is required to be deducted only under this provision and not under any other provision. This amendment is applicable with effect from 1st of July 2022. We have been given a threshold limits. And when we discuss this threshold limit, friends, first let me clarify one point, that this obligation to deduct TDS under 194S is applicable for each and every SSE. Even in a case where you are an individual or HUF SSE not having turnover of more than 1 crore or gross receipts of more than 50 lakhs, even in that case, you are required to deduct tax at source. The only benefit which is given to you in this case is a higher threshold limits. So what are the threshold limits which are applicable in this case is normally a threshold limit of 10,000 is applicable. So in a year, if I'm not paying consideration in aggregate for more than 10,000 for getting VDA from one person, I am not required to deduct TDS under 194S because of that exemption due to this applicability of a threshold limit. But in a case where you are an individual or HUF, either you are not having any business or profession at all, or if you are having business or profession, but your turnover or gross receipts were not exceeding of the preceding financial year, were not exceeding those general limits of 1 crore 50 lakhs, in that case, you have been given a higher threshold limits. You need not deduct tax at source up to 50,000 rupees, but if the transaction amount in aggregate in a year is more than 50,000, then in that case, you will also be required to deduct tax at source under section 194S. The first issue which is going to arise out of this particular discussion on 194S is that whether the TDS provision will apply in a transaction where there is a consideration flowing which is in kind. You'll be wondering as to why I'm raising this question when I'm discussing a specific slide with respect to this, that when there is a consideration which is in kind, I need to ensure that the tax has been deducted. I'm discussing this issue is because when you refer this provision, it starts with the wording that a person responsible for paying a sum by way of a consideration. And further, it provides that the TDS is to be deducted at the time of payment or credit, whichever is earlier. A similar language has been used under other provisions which we are applying today in our day-to-day life, like 194C, J, etc. And in number of cases, this issue is arising. So, for example, if you consider a case of Red Chili's Entertainment, where that company had paid some professional fees to an actor in kind, and there a question arose that whether 194J provisions are applicable. Their tribunal took a view that TDS provisions are not applicable in a transaction where the consideration is paid in kind. A question arose in 194LA where it reached up to High Court, Karnataka High Court, in the case of Bangalore Palika, where compensation was paid for compulsory acquisition, which was in the form of TDR and not a monetary compensation. Once again, a view was taken that for consideration in kind, TDS provisions will not apply because they are using this language of payment of a sum, and TDS is applicable at the time of payment or credit. Okay. But even an adverse view also has been taken in a recent case of a Punjab state warehousing, where tribunal logically concluded that if otherwise the consideration is settled in a monetary form, but only a form of discharging consideration is in kind, in that case TDS provision will apply. So all these issues are going to arise, but here in 194S, this issue will be not so strong for the SSC to argue that the TDS provision should not apply, is because there is a specific proviso which deals with a transaction where there is a consideration which is flowing in kind. Now, in a case where we have been told that if the consideration is payable is in kind, you have to ensure that the tax has been paid on transfer of BDA. Now, what do I do in this case? What do I mean that I have to ensure that the tax has been paid? Whether I need to ask that person that show me a challan whether you have paid this tax on this particular consideration or not, and then only I'll release this consideration. Is it so? We don't have any clarity, but when the similar provisions were inserted in 194B in 1997, a circular was issued by CBDT, and their CBDT said that one of the manner in which you can ensure this is that you can ask that person to pay certain amount in cash to you, which is sufficient to pay your TDS. So you recover this amount in monetary form from that person and pay your TDS. This is a simplest way in which you can comply with this particular provision. But I'll just point out that Karnataka High Court in the case of Hindustan Liver took a view that even if you fail to do so, in that case, what are the consequences? Normally, if you fail to comply with the TDS provision, we have the consequences under section 1. And what are the consequences? That SSC would be considered as an SSC in default. But here Karnataka High Court took a view that section 201 can be invoked only in a case where that person has failed to deduct tax at source or failed to pay the TDS after deducting that amount at source. Now here is a case where the provision itself provides that you need not deduct because there is no monetary payment by you, and therefore it's not possible for you to deduct something. So you need not deduct, but only thing is that you have to ensure that the tax has been paid. And therefore, since the provision itself is providing a relaxation from deducting tax at source, that person cannot be considered as an assessor in default under section 201 at all. That is a view which had been taken by Karnataka High Court in the case of Hindustan Liver. But the penalty under section 271C or a prosecution under section 276B can follow. But today, both of this provision, penalty as well as prosecution, they are making a reference to a similar transaction only under 194B. They are not being amended with this finance bill, at least till now, to make a reference to section 194S. And therefore, till the time that amendment has been made, even the penal consequences or prosecution consequences won't apply. Now, VDA in exchange of VDA. This will be a quite complicated transaction, because in this transaction, both the persons will have to comply with this requirement of 194S. Is because in that case, both the persons are paying consideration for transfer of VDA to another person. Okay, I have VDA, I'm exchanging my VDA with you for, and I'm getting VDA from you. So I am paying consideration to you for transfer of VDA. You are also paying consideration to me for transfer of my VDA to you. So both of these persons will have to comply with this requirement of TDS. How one will value this consideration and how to ensure that the tax has been paid, all these are open issues which I've already discussed with you. Consider the next issue, which is a very interesting issue, is that what if that person who is normally engaged in a business of sale of goods or providing services, that person in the course of his business, he is receiving consideration for sale of goods or services in the form of VDA. Now here, as a seller or as a person providing the services, you will have to deduct this tax at source under section 194S. So normally we understand that the TDS provisions are applicable in a case where that person is a buyer or person is a person who is availing services and making some payments for this. In that case, this 194C, 194J, etc. will apply. But here is a reverse case. So take an example that I have some goods. You are interested in buying these goods from me. I am selling these goods to you. And as a consideration for sale of these goods, you are not paying cash to me in Indian rupees, but you are paying this consideration to me in Bitcoin. So I am receiving Bitcoin from you. So here what is happening is that I am a person responsible for paying consideration of transfer of Bitcoins to me. And what is that consideration which I have provided to you for transfer of Bitcoins to me is I have sold my goods to you. So this is the consideration in kind, which is flowing from me to you for transferring Bitcoins to me. And as a result, I will have to comply with this requirement of deducting tax at source under section 194S, or rather ensuring that the tax has been paid, because now we are talking about an example where the consideration for transfer of VDA to me is flowing in kind and not in a monetary form. In case of crypto exchange transactions, who will be deducting tax at source? There is no clarity. CBDT will have to clarify this position, but perhaps the settlement agencies will have to take care of this requirement of deducting tax at source. What if the non-resident is buying cryptocurrencies or VDA from a resident person? Whether the non-resident will also be required to deduct tax at source? This is an open issue which is arising even in other TDS provisions today under 194C, 194J, etc., where the condition of residency is only with respect to a pay. So whether a non-resident payer is also required to deduct tax at source is the same issue which is arising under all other TDS provision. Consider a reverse case, that if you are buying virtual digital assets from a non-resident, now whether TDS under 195 will apply or not is a question which can be deliberated. Here the difficulty which will be arising is that since we are now dealing with a non-resident, we will have to first understand whether that income is arising in India in the hands of the non-resident. And as per section 9, that income can be considered as accruing in India if the asset is located in India. So here the question is that where this VDA is located, whether it is located in India, whether it is located outside India, or it is not located anywhere and it is located in a virtual world, is something which is very difficult proposition to understand and take a position on that particular question. So now, since we are dealing with this TDS provision, let me further discuss some of the other amendments in other TDS provisions. So the first amendment in other TDS provision is section 194IA. Any questions with respect to the taxation of VDA before I take up some other amendment with respect to other TDS provisions?
Participants may unmute themselves and ask the question.
Identify the buyer or seller in case of VDA transaction, because these are run through wallets. So this I've already clarified that if you are dealing with the crypto exchanges, etc., CBDT will have to clarify and will have to come out with some kind of a clarification that whether the settlement agency will have to take care of this obligation to deduct tax at source, because the TDS is required to be deducted by the person who is responsible for paying that consideration. And therefore, technically speaking, that person who is paying that consideration will have to comply with this requirement of TDS. TDS under section 194IA, very simple amendment, and therefore I'll deal with this amendment quickly. While purchasing an immovable property, till today we were required to look at only the amount of consideration, and we were supposed to deduct the TDS at 1% on that amount of consideration. Now the amendment is proposed that you need to now apply this TDS on consideration or stamp duty value, whichever is higher. So that is a simple amendment now, which is applicable with effect from 1st of April 2022. And as a corollary, we have been told in this amended provision is that now when you are looking at this threshold of 50 lakhs, you have to consider both these amounts, consideration as well as stamp duty valuation. And therefore, moment either of this is more than 50 lakhs, we need to deduct this TDS under section 194IA. So consider an example where I'm buying an immovable property and I'm paying consideration only 45 lakhs. Then as per the existing provision, I did not deduct the tax at source under 194IA. But now after the amendment, if in that case, though I'm paying consideration of just 45 lakhs, but my stamp duty value of that property which I have purchased is, say, for example, 60 lakhs. Now here, since one of these two is more than 50 lakhs, I will have to deduct tax at source, and I'll be deducting TDS on the higher of these two amounts. And therefore, in my example, I will have to deduct TDS at 1% on the stamp duty value, which is 60 lakhs rupees. Now, under this simple amendment, let us try to understand what is the objective of this amendment. In the memorandum, it has been clarified that, look, there is a disparity, inconsistency between the taxability provision and TDS provision. If you refer 43CA or 50C, it provides for the taxability of the amount which is higher of consideration and stamp duty valuation. But under the existing provision of TDS, the TDS is applicable only on the consideration. And therefore, the objective is to bring both of these provisions on par, taxability provision as well as TDS provision. Agreed. But in that case, what about the benefit of 10% which is provided for the purpose of taxability under 43CA or 50C? We all know that if the difference is only up to 10% of the consideration, in that case, that provision do not apply, and the taxability will be determined only on the basis of the consideration, not on the basis of stamp duty valuation. But for the purpose of TDS, the buyer will have to deduct TDS under section 194IA on the stamp duty value if that is higher, irrespective of what is the percentage of difference between the consideration and a stamp duty value. The question is that whether now this requirement of deducting TDS on a stamp duty value, whether this will apply even in case of a gift transaction. The answer to my mind is no, is because we need to compare the consideration and a stamp duty valuation. In case of a gift transaction, it cannot be said that the consideration is zero. It is a transaction which is without consideration, and therefore in a transaction which is without consideration, TDS just on a stamp duty valuation cannot be made applicable. That comparison fails. That person is not responsible for paying any consideration, and therefore at the outset that provisions do not apply, and therefore there is no question of deducting tax source on a stamp duty valuation. Now consider this funny situation which is going to arise. 194IA requires us to deduct tax at source at the time of payment or credit, whichever is earlier. Now, in a case where my stamp duty value is higher as compared to a consideration, that difference I am not going to pay, and I'm not going to credit that amount in my books of accounts. So the question is that when I'm supposed to deduct tax at source on that particular difference, can it be said that the mechanism fails because the TDS provision will be effective only if the amount is paid or credited? In the absence of payment or in the absence of credit, TDS provisions fails. And therefore, can it be said that since the mechanism has not been provided for the purpose of deduction of tax at source on this amount, TDS is becoming, this amendment is becoming ineffective? Or alternatively, can it be said that the difference needs to be spread on a pro rata basis over all the payments if the payments have been made on installments, or at the time of conclusion of the entire transaction at the end, or at the beginning? There is no clarity on this particular point, and therefore we need to wait for some clarifications or for some further amendments in this proposal of amending section 194 IA. In case where you are dealing with co-owners, there probably the situation seems to be simpler, is because in that case, in the proportion in which you are paying consideration to all the co-owners, probably in the same proportion, even that difference should be distributed, and accordingly the TDS should be deducted in the PAN number of all the co-owners in that case. The objective with which this particular provision has been introduced is failing is because here the comparison is made between a consideration and a stamp duty value. The comparison is not between an agreement value and the stamp duty value. The word consideration has been defined for this purpose, where an explanation has been inserted just a year ago. And in an explanation, we have been provided that this consideration will include all types of fees like car parking fees or club membership fees or development charges or maintenance fees or some fees which has been charged for the purpose of providing facility of electricity and water, etc. And therefore, it is not merely an agreement value. So for the purpose of taxability, effectively, we have to make a comparison between agreement value and stamp duty value. But here, it will be a comparison between a consideration amount, including all this component, and stamp duty value. And therefore, the objective which has been explained is failing to some extent as far as this particular amendment is concerned. Next amendment under TDA is the section 194R. A new provision has been introduced, which is becoming effective from this year. It appears to me that this government or probably this finance minister is a TDS or TCS lover, because if you see the history of last around 3-4 years, we have seen that there are number of new provisions of TDS have been introduced. TDS on goods and TCS on goods, and then e-commerce operator, TDS on cash withdrawals, so on and so forth. Okay, this journey of all this TDS provisions started from section 194, and then all other sections were introduced with 194A, B, C, etc. And today now we are on 194R. And shortly, I'm very sure that within a year or two, we will be talking about TDS provisions like 194Z. And then if there is a further need, the provisions will be introduced like 194ZA, ZB, ZC, etc. So that those days are not too far. Nevertheless, now we need to understand this new TDS provision. What is the background behind insertion of this new TDS provision is that there is a clause 4 in section 28 dealing with taxability of business income, and it provides that the person who is carrying on that business or profession, whatever benefits or perquisite which is receiving during the course of that business or profession, value of this benefits or perquisite is taxable as his business income. So basically, we are talking about taxation of perquisites in the hands of that businessman. We had some provisions dealing with salary income for the purpose of taxability of perquisite. We have similar provision dealing with taxability of perquisites arising in the course of the business or profession. But it has been noticed that in many of the cases, or probably in majority of the cases, those persons receiving these benefits or perquisites, they are not reporting this in their ITR, that they are not paying any tax on those benefits or perquisite. Why? The reason is because they have not been routed through a normal banking channel. We are talking about benefits or perquisites which are in a non-monetary form, and therefore they have not been routed through a banking channel. They do not come in a system, and therefore it is very difficult for someone to identify whether such benefits or perquisites in kind were received or not, and whether they have been accounted for or not. And therefore what has been done is that TDS provision has been made applicable, and therefore the person who is giving this benefits or perquisite will have to deduct tax at source. And once he is deducting tax at source, automatically all these transactions will get reported in form number 26As, and therefore it will be easier for the department to capture all these transactions and to see whether the corresponding income has been offered in the ITR by that person or not. It is with this objective a new section 194R has been inserted. What are the provisions, or what are the important points of this provision is that which is that transaction on which TDS will apply. So for the purpose of understanding this, I have just explained clause 4 of section 28. But when you read section 194R, the way in which it has been proposed, it doesn't say that whatever is taxable under 28(4), the payer will have to deduct tax at source on this. It doesn't say so. So the transaction which is subject to TDS is any benefit or perquisite, whether it is convertible into money or not, the person who is providing this benefits or perquisite will have to deduct tax at source, provided those benefits or perquisites are such that they are arising from business or profession in the hands of that recipient. Once again, if you are providing this benefits or perquisite to a non-resident person, 194R will not apply. 194R will apply only if you are providing this benefits or perquisite to a resident payee and not otherwise. What is that amount which will be subject to TDS is the value of this benefits or perquisites, or if you are providing multiple benefits or perquisite, then in that case you need to apply this TDS on aggregate value. TDS will apply at the rate of 10%. There is a threshold of 10,000. You are not required to deduct tax at source if the aggregate value of all benefits or perquisites provided to the same person in the same financial year does not exceed 20,000. Then you are exempted from the requirement of deducting tax at source under section 194R. And further, if you are an individual or HUFSSE and your turnover or gross receipts of the preceding financial years were not exceeding those normal limits of 1 crore or 50 lakhs, then in that case also you are not required to deduct tax at source under these new provisions of section 194R. Further, we had been provided a provision which was just similar to the one which we discussed for cryptocurrency, virtual digital asset 194S, which provides that if you are providing this benefits or perquisites in kind, or partly in cash and partly in kind, where your cash component is not sufficient for TDS, in that case, what are you supposed to do? The same thing. You will have to, before providing this benefits or perquisite, you will have to ensure that the tax has been paid on this value of this benefits or perquisite. So a similar clarification probably will apply, that you will have to receive the equivalent amount equivalent to TDS from that person to whom you are providing this benefits or perquisite, and you will have to pay this in the form of TDS. This is the simple provision of section 194R. But such a simple provision will have far-reaching consequences. Number one, what do I mean by benefits or perquisite? This is something which is not defined for the purpose of section 194R, and therefore probably we will have to take the help or guidance from all those decisions which are available today in the context of section 28 clause number 4, because their similar words have been used. But for the purpose of understanding of this provision, let me put up some of the examples for thoughts. I'm not going to conclude that whether this can be considered as benefits or perquisite, but I'm just raising this question and I'm just leaving it to you, that whether this would be regarded as benefits or perquisite, and if yes, they have been regarded as benefits or perquisite, then the person who is providing this benefits or perquisite will have to deduct tax at source. So just to begin with, the simpler examples are that in the course of your business, you are providing some incentives to your dealers, etc., that if you are buying goods for a value exceeding, say, for example, 1 crore in a year, I'm going to offer you some additional discount. Whether that would be considered as benefits or perquisites. So in a P&L account, we have a common item of expenses, which is a sales promotion expense. And in this sales promotion expense, so for example, you have a transaction where on certain festivals like Diwali, etc., you have purchased some gift items and you have distributed those gift items to your customers or some representatives of the customers. Whether this would be regarded as benefits or perquisite, probably to my mind, yes, that would be considered as benefits or perquisite, and therefore probably that sales promotion expenses would be on radar of the department, that whether you have provided benefits or perquisite under the sales promotion. If yes, whether you have deducted tax at source on this, and if not, whether the disallowance under section 40A1A will apply or not. You can consider certain hyper-technical example where, for example, there are a few assets which are otherwise owned by a partnership firm, but as a partner, I am using the assets owned by a partnership firm for the purpose of my use. So, for example, there is an office premises which is otherwise owned by a partnership firm, but the partner is using this office premises without paying any rent to the partnership firm. Now, in that case, whether it is resulting into a providing of a benefit or a perquisite by a partnership firm to a partner. Consider an extreme example where one of the group concern is giving a loan on an interest-free basis to another group concern. Whether it is resulting into a benefit which is provided to that company, to that entity to whom that loan has been given, but on an interest-free basis. So do I need to consider this notional interest and whether that entity giving loan will have to deduct tax at source under section 194R. So just imagine the far-reaching consequences of this simple provision of section 194R, which is inserted for applying TDS on benefits or perquisite. Now the question is, another question is that in a case where I am providing this benefits or perquisite in monetary terms, cash benefits, cash perquisites, whether the TDS under this provision will apply or not. When I was dealing with 194S, I was raising an issue that whether in a case where the consideration is in kind, whether TDS will apply. Now here is a case where I'm talking about the benefits or perquisites in cash, whether this TDS will apply or not. And why I am raising this question here is that because section 28 clause 4 is using a similar terminology as I have already mentioned to you. And there this issue as a reason, the dispute has reached up to Bombay High Court and approved by Supreme Court, wherein a principle is laid down that since if you read that clause, it uses the words benefits or perquisite, whether convertible into money or not. And since these words, whether convertible into money or not, have been used, it has been held that it indirectly implies that those benefits or perquisites cannot be in a cash form, cannot be a monetary form. It has to be, first of all, in a non-monetary form. Now, if the same language has been used for in this proposed provision of section 194R, the issue is that whether the same interpretation can be extended to 194R. Here, it would be difficult to do so is because, as I have just explained, there is a specific proviso which provides that if there is a transaction which is partly in cash, partly in kind. So indirectly it means that the idea is to capture even the benefits or perquisites which are provided in cash. The another issue is that TDS is applicable on value of this benefits or perquisite. And how do we arrive at this value? We need to have some clarity on this, that how do we arrive at the value of all this benefits or perquisite for the purpose of applying this TDS. Now look at another condition which is applicable for the purpose of application of this TDS provision, which says this benefits or perquisite which you are providing, for the recipient, this benefits or perquisite should be such that they are arising in the course of their business or profession. Now, as a person who is providing this benefits or perquisite, how do I ascertain this? Just consider a simple example of companies like DMart. Now, if hypothetically, this DMart comes out with a scheme that any customer who is buying goods in aggregate in a particular period for a value of more than certain amount, then we will be offering certain additional discount of, let's say, 2% or 5%. Now, this is also nothing but a benefit or perquisite provided to the customers. Now, if you apply this TDS provision in the hands of the company like DMart, how they will come to know that the customers who are buying goods from us, and as a result, they are getting this benefit from us, whether this benefits or whether they are buying these goods for the purpose of their business, or whether they are buying these goods for the purpose of their personal consumption. And therefore, it is very difficult for the payer to decide or payer to ascertain this situation in the hands of the recipient. If you are dealing with like dealers, etc., it would be a simple, and you can assume that it is always arising in the course of business, etc. Now, as a tax auditor, if any transactions are reported under 194R, as a tax auditor, we will have to ensure that whether the corresponding amount of income has been offered in the P&L account or not, and whether it has been offered as business income under section 28 or not. If it has not been credited to P&L account because they were in kind, then the tax audit report will have to be qualified to that extent, because there is a specific clause which is meant for this. The date of applicability, there is a doubt, is because Finance Bill is making this provision applicable from 1st of April 2022. But if you read the memorandum, it says that this will apply from 1st of July 2022. So unless this particular conflict is removed, we need to apply this provision right from 1st April 2022, because the Finance Bill will override and will decide the correct situation and not the memorandum. TDS on non-filers 206AB as well as 206CCA. Here we have a very simple amendment. Till now, in order to apply this higher rate of TDS under this provisions, specified persons, the portal was telling us that whether this PAN number is a specified person or not. But on the back side of this, the condition was the status of that ITR filing of that person was required to be seen, as well as what is the aggregate amount of TDS or TCS which is reported in his case. Now, this status was required to be seen for 2 years and for both the prior assessment years for which the due date has already expired. Now there is an amendment which is proposed, and it says that now the status of ITR filing as well as aggregate amount of TDS or TCS needs to be seen only for one prior assessment year and not for 2 prior assessment years. And therefore, now more and more persons would be captured as this defaulters for the purpose of 206 AB, and higher rate of TDS will be becoming applicable in such cases. 3 more provisions have been excluded from the scope of 206 AB, which is 194 IA, immobile property transactions, and 194 IB and 194 M, which had just become applicable with respect to those individuals and HUF assesses not having that specified turnover there. They were also required to deduct tax at source on certain higher amount of payments. There's one small change in the section 201 interest computation, and look at this change, is little disturbing. It says that wherever an order has been passed by the assessing officer considering you as a defaulter assessee under 201, then in that case interest will be payable by you in accordance with that order of the assessing officer. So now assessing officer is made a king of this. Assessing officer will decide what is the amount of interest which is payable by you, and whatever amount of interest which he writes in the that order, you will have to pay that interest. I know that assessing officer cannot go beyond the provisions of the act while computing that interest, but the point is that how can we have such a provision in the act which provides that whatever is assessing officer is asking you to pay, you will have to make a payment of this. We can't have such a provision. The objective for which the provision has been introduced in the act, that itself is not becoming very clear as to what was the need. Perhaps I could just reconcile the need of this amendment, that 201 subsection 1A, if you refer to this provision in which the manner of computing the interest has been provided, it breaks this period into 2 periods. For one of the period, higher rate of interest, that is 1.5% is applicable, and for the other period, the lower normal rate of 1% which is applicable. Now, breaking of this period is with respect to the date of deduction of tax at source. So till the time the tax is deducted and after the tax is deducted, these 2 periods are considered separately. But in a case where I have not deducted tax at all, I have just paid the entire amount to the payee, but still I can be considered as a defaulter. And therefore, here in the absence of deduction of tax at source, that date itself is not there. So if that date itself is not there, how do we divide this period into 2 periods was a difficulty probably, and that is the reason why this amendment is proposed. But instead of clarifying as to what will be the alternative manner, they just said probably they also could not think of the alternative manner, and therefore they simply provided whatever is assessing officer is computing, you will have to pay the interest in accordance with the order of the assessing officer. The next is an amendment to section 68. A very important amendment, and there is a history behind this. Any further question before I? So, section 68.
There is one question, whether expenses incurred for dealers meet at assessor's place or in other state or countries. So maybe like ticketing, lodging, boarding. Bhadresh, you are on mute.
Is it a benefit or perquisite for the dealers? I don't think so. You are conducting a meeting for them, which is for the purpose of your benefit, your business, not for their benefits. And therefore, it is just conducting a meeting. These expenses cannot be considered as benefits or perquisite for them. And therefore, there is no requirement to deduct tax at source on this expenses. So the amendment to section 68 is that first we need to understand in 2012, a similar amendment was proposed. I mean, it was made effective, but it was having a limited applicability. So this, due to this, now further amendment has been proposed, and that further amendment is that a new proviso has been added in section 68 over and above the existing one, which is applicable in a case where the amount which is credited in your books of account is consisting of loan or borrowing or any such amount by whatever name called. If the credited amount is in the nature of this, that is loan, borrowing, or any such amount by whatever name called, in that case, the source of source is also required to be proved. That means the creditor in whose account that amount has been credited in your books, that creditor will also have to offer an explanation about source of that amount in his ends, and that too to the satisfaction of the assessing officer. And if this cannot be explained, then the result of this would be that this would be considered as an unexplained cash credit in the hands of the assessee in whose books this loans or borrowings or such other amount has been credited. When you look at memorandum, the memorandum is applying this condition of proving source of source to loan or borrowing or any other liability credited in the books. Memorandum is becoming too wide. Okay, it virtually practically capturing each and every credits in the books. But that is not the correct interpretation, the manner in which it has been worded in the memorandum. We need to look at the finance bill, and when we read the amendment, it refers to only loans or borrowings or any such amount. So that other amount should be once again in the nature of loans or borrowings, and then only this amendment would apply, not otherwise. So what will be the this amendment is effective from assessment year 23-24 and not applicable to the prior assessment year. And the only exception is when you are dealing with a venture capital fund or a venture capital company, that exclusion with respect to VCC or VCA was even available, even otherwise at present with respect to that existing proviso dealing with share capital. So now we have two provisos. Just to make this position very clear to all of us, the comparison between the existing proviso and a new proviso, the existing, both of them are asking us to prove the source of source. And in the absence of proving of source, that amount would be considered as an unexplained cash credit in our hands. The existing proviso was applicable only to closely held companies and not to any other assessees, whereas this new proviso is applicable to all types of assessees, including companies, individual, HUF, everyone. The existing proviso was applicable only with respect to a share capital transaction, whereas the new proviso is now applicable to a transaction of a loan or borrowing or that any other amount of a similar nature. The existing proviso was not applicable in a case where the person from whom that share capital was received was a non-resident person, because those transactions were subject to FEMA regulations. Whereas new proviso, there is no such exception, and therefore technically speaking, even in a case where the loan has been received from a non-resident, this new proviso is technically applicable and the source of source is required to be proved. What will be the consequences if we are not able to explain the source of source? We know that this would be regarded as an unexplained cash credit, and therefore now this would be taxed under section 115 BBE at the rate of 78% and further penalty of 10% under the applicable provision. There are no exceptions except for transactions with VCC or VCF, that is venture capital company or venture capital fund. There are no other exceptions for any kind of genuine cases. We understand that probably there are hardly 1 or 2% of all total transactions of loans or borrowings which are happening are not genuine transactions. There are some entry operators or there are some accommodation transactions which are taking place. But just because of this 1 or 2% transactions which are not genuine or bogus, entire 100% transactions of loan or borrowing have been made subject to this test. Barring with this VCC or VCF, no further exceptions have been provided. This is something which is very harsh and unjustified. There is a need to make a strong representation on this point that this provision cannot be made applicable in this manner. Technically speaking, if I give you an example, even in a case where I am borrowing, I am raising a loan from a bank, technically speaking, the assessing officer can ask me, can raise a question during the assessment that you prove what is the source of this loan in the hands of the bank. Because there is no exception to this case that if you are raising this loan, receiving these loans or borrowings from the entities like bank, this further requirement of proving source of source won't apply. Consider even an extreme example. If the banks are receiving loans, even in that case, the banks might have to prove what is the source of this loan in the hands of the lenders. That is the manner in which these provisions have been made applicable, without providing for exceptions for genuine cases. So every entity raising loans, borrowings, or some kind of instruments which might be possible that they are listed somewhere on the exchange like debentures, etc. Even in those cases, the source of source will have to be proved, and if that cannot be proved, all the consequences will follow. The question is, to what extent, when I say source of source needs to be proved, what is the extent to which I'll have to prove the source of source? If I furnish a bank statement of that creditor, is that enough? And if there are no corresponding cash deposits, and all the transactions are coming through normal banking channel from which he has given me this loan, whether that is enough, or I need to explain exactly as to what is the source in his ends and from where he got this money. And this is how out of this amount he has given this loan to me. That is the meaning of source or source. So far, we don't have any interpretation available, a detailed interpretation available on what do we mean by source of source. And consider a case where I am able to explain what is source of source, but this was a case where that source of source was something on which the tax was not paid by that person. So I am receiving a loan from some person, and the immediate source from which that loan has been given to me is, for example, some rental income. He had some property. He's able to demonstrate with the evidences that he was the owner of the property was given on a rent, and he was receiving this rent from his tenant. So the source is the rental income, but the fact is that he has not paid the tax on this rental income, or probably he has even not filed the ITR. But the fact is that I am able to explain as to what is the source of this source. So in that case, can this be considered that the source of source is not explained to the satisfaction of the assessing officer? To my mind, the answer is no. Now, if at all the tax has not been paid on that source of source, in that case, whatever actions can be taken in the hands of that particular creditor can be taken by the assessing officer, but certainly that amount cannot be taxed in my hands by claiming that this condition has not been satisfied. I just move on to the next amendment, which is also dealing with this similar types of the transaction of undisclosed income. Now, with respect to set-off of losses, today we have a condition, or today we have a restriction on set-off of losses, but only under section 115 BBE, that you can't claim a set-off of loss. Now, that restriction is applicable only when there is an income from unexplained sources like section 68, 69, etc. But that restriction on claiming set-off of loss is not applicable in a case where I have an income, the source of which is explainable, but this income is an undisclosed income. So we are dealing with two different propositions. Let me just make this position very clear. The one is the income from unexplained sources. So I have an income, but I am not able to explain as to from where I got this income. The source itself is in a question not explainable. And the second is a case where I have an income. I am able to explain what is the source of that income. Take the very same example of a rent. I have a rental income. I know what is the source. I have explained the source with the evidences. But the fact is that the tax is not paid on this income. This is an undisclosed income, the income which has not been included in my return of income. So the restriction on set-off of losses is only with respect to the first type of income, not with respect to the second type of the income. So now the objective is to deny the set-off of losses with respect to even the second type of income, which is an undisclosed income. And with this objective, a new section 79A has been inserted with effect from AY 22-23. It starts with the non-obstant clause having an overriding effect over all other provisions of the Act. And this is applicable in a case, only in a case where there is a search, requisition, or survey is being conducted. It will not apply to any type of the undisclosed income which has been added during the course of the assessment. So it is not the case that you had some transactions in which you have earned the income, you didn't include this income in the ITR. The assessment has been made and now that income has been added, and therefore set-off of loss will not be allowed. That is not the case. This undisclosed income should have been found as a result of search, requisition, or a survey other than a TDS survey. Then only this restriction will apply on claiming set-off of losses against this undisclosed income. Undisclosed income is something which is defined for this purpose. I am coming to the meaning of this term undisclosed income. Now, if such an undisclosed income is found as a result of any search, requisition, or a survey, then what will be the result of this? The result of this that we will not be allowed any set off of any brought forward losses or current year's losses or any unabsorbed depreciation under 32(2) against this undisclosed income. That is the only restriction. There is no further consequences which are provided at least under section 79A. There can be some penal consequences, etc., which might apply under other provision, but 79A provides that you will not be allowed a set off of these losses. That's all, nothing more than that. What do I mean by an undisclosed income? That is something which is well defined for this purpose. It is similar to a definition of an undisclosed income which has been provided in section 271 AAB. There is no difference, and therefore I am not discussing this definition of an undisclosed income in detail, but just quickly, it provides for two things. One, any income which is represented by some assets or books or documents, etc., which was not disclosed, but now it is found as discovery of these assets, books, or documents, etc., during the course of the search, survey, etc. Or the second one, income represented by an entry of expense, which is recorded, though recorded in the books, but now these expenses are found to be false as a result of the search, etc. For example, bogus purchases. So this would be considered as undisclosed income. The important issue which is arising over here is that whether this restriction on claiming set off of losses in such a scenario, whether that will apply only in the case of that person in whose case that search, etc., is conducted, or whether that will apply even in the third party's assessment. So let me give an example to understand this issue. The search has been conducted, for example, in the case of a builder, where some diary, etc., are found wherein some receipt of on money, etc., have been recorded. Now, I am, for example, is a buyer of one of the property from that builder. Now, due to that search, these evidences are found, and now I have been assessed or reassessed under 147 for taxing that particular amount of on money which has been paid. Now, here this will become, and probably in all probability, income from unexplained sources. But assume hypothetically that I am able to explain as to what is the source of that on money, but I had not paid the tax on the source of that on money payment. Now here that will be considered as my undisclosed income that will be added in my hands. And the fact is that this undisclosed income has been discovered as a result of search. The only difference is that the search has not been conducted in my own case, but the search has been conducted in someone else's case. Now here, in such a scenario, whether this restriction on set off of loss as per new section 79A, whether that will apply even in my case, the answer is not very clear. But today, as the provision stands and how the manner in which this provision has been worded, it appears that this restriction on claiming set off of loss would apply even in third parties cases, not necessarily only in the person in whose case that the search has been conducted. There is no restriction on claiming all other expenses, including current year's depreciation. The restriction is only on claiming set off of losses and unabsorbed depreciation. That's all. This income will not be taxed at a special rate of tax. That will be taxed at the applicable rate of tax. So, for example, there is a search which is taking place today, and some documents revealing sale of some properties are found, for which I have not declared the long-term capital gain if they were long-term in nature. Now, merely because this long-term capital gain was undisclosed, it doesn't mean that as per 79A, it will become undisclosed income for the purpose of charging tax at a higher rate. That will be taxed in accordance with the other normal provisions which are applicable to me. The only restriction as per 79A is that set off of loss will not be allowed to me against that particular undisclosed income. Whether internal set off is permissible. So, for example, due to search, multiple undisclosed transactions are found. Few of them are resulting into income, few of them are resulting into losses. So, for example, stock market transactions were not disclosed at all. Few of them earning gain, few of them incurring losses. Whether internal set off is possible, the answer probably is yes. The restriction should be on a net result of all undisclosed transactions. If that is an income, the loss set off of losses against that undisclosed income is not permissible as per this new provision of section 79A. So, Parin, I have about another 15 to 20 more minutes for my.
Yes, sir. You may continue. No problem.
Yeah. So now I'll be coming to The another category of the amendment which I consider is lesser important amendments, though they are important one, but for the purpose of all the participants at large, I thought that I should first prefer discussion on the important provisions which might apply in our day-to-day practice. So coming to the amendments related to faceless assessment. So this is the position of the finance minister after introducing this scheme for faceless assessment and the corresponding provision under the Income Tax Act. And that is the reason why these provisions were required to be amended. And that is the reason why we see all these amendments through this Finance Bill 2022. So I'll just quickly summarize what is the effect of all these amendments. The first is, now we are going to have only a faceless center at national level. Now we don't have any more concept of a regional faceless center for the purpose of assessment. The existing provision was quite lengthy. Now it has been shortened quite, and it has been simplified a lot. Okay. Then as per the existing provision, it was possible that there was a multiple layering of several assessment units in the same case. So same file of assessment could travel from one assessment unit to another assessment unit, more particularly in a case where the review unit has given their adverse report. Now that has been avoided, and the procedure has been amended in such a manner that only one assessment unit would be involved throughout till end for the purpose of making one assessment. So what is the change as far as the procedure is concerned? So I have given 3 slides in my presentation, giving you in nutshell, step by step, what was the existing provision and what is the proposed procedure. I'll not be dealing with each and every step, but I'll just clarify that what has happened is that under the existing procedure for the assessment, it was so lengthy that first there was a need of preparing a draft assessment order, and then revised draft assessment order, and then final draft assessment order, and then finally the final assessment order. So there were multiple stages through which an assessment file was required to pass through. Now that procedure is quite simplified. You can see in my slide that as per the existing procedure, I could summarize them in 10 steps, but the proposed procedure is so simplified that now there are only 7 steps if we can just summarize. So now this procedure is simplified. It's a ease of doing government business, basically, not a taxpayer's business. So what has been provided now in the proposed procedure is that the assessment unit will be first preparing ILDP, which is an income and loss determination proposal, that will be forwarded to National Center. The National Center will run through the system on the basis of that risk strategy, and if required, will send it to a review unit. Not in every cases, but wherever required. Review unit will send their review report. Review report will be forwarded to the same assessment unit, and thereafter the assessment unit will be now closing the assessment by passing a draft assessment order, by incorporating whatever suggestions which have been recommended by review unit, and that too at their discretion. If they want, they will, or if they can omit all those suggestions which have been forwarded to them by a review unit. So this is how that procedure has now been simplified. One very important change is that while dealing with this assessment unit in a faceless manner, today as per the existing provision, the SSEs could ask for a personal hearing. Now personal hearing doesn't mean face to face, but through video conferencing only. And if you request for this personal hearing, as per the existing provision, it was at the discretion of the chief commissioner handling that particular center, whether or not to grant for that personal hearing through video conferencing. Now that discretionary power has been removed. It has been made mandatory. So once now as an assessee you request for any personal hearing through video conferencing, that has to be granted by that particular assessment unit to you, and it cannot be denied. That's a welcome change as far as this faceless assessment is concerned. Now look at this last change as far as this faceless assessment is concerned. Subsection 9, as existing in section 144B, has been completely omitted, and that too with retrospective effect from 1st of April 2021. What is the effect of this? Subsection 9 was providing a provision in a manner that whatever procedure for conducting an assessment which has been laid down in subsection 1 to 8, in any case, if the assessing officer is not following that particular procedure, or making an assessment contrary to what are the provisions which have been provided in subsection 1 to 8, in that case, that assessment was regarded as a non-est assessment, as if void ab initio, as if that assessment has never been made. And it is under this provision in several cases the writ petitions were filed before the High Court. So I'll just give you a simple example that there is a requirement that if the additions are proposed, the draft order first should be given to the SSE by giving an opportunity to counter. Now, if that without providing for the draft order, if the assessment is closed by passing the final assessment order, in several cases in the writ petitions, High Courts passed the order that this assessment is becoming an invalid assessment, void ab initio, and all those assessments were quashed. So this was resulting into a trouble for the department. So first they made a procedure. They came out with a provision: if the procedure is not followed, then the assessment will become non-est. Procedure was violated in many of the cases. High Courts considered them as non-est, and now they are amending the provision to say that, look, whatever was provided earlier, now we are removing that with retrospective effect. So this is the manner in which the provisions have been enacted under the law. The question is that indirectly, whether an open license has been given to the officers that, look, we are providing for a particular procedure. If you're following, is good. But even if you are not following, then the consequences will be not such harsh that the assessment itself would be becoming a non-est assessment. Few simple changes with respect to a reassessment. First, a hot controversy which is going on today. In several cases, the High Courts have struck down the notices of reassessment under 148 issued on or after 1st of April 2021 on the ground that the new provisions have already come in effect and the notices were issued in violation of the new provisions. No amendment have been proposed to overrule all those decisions. So all those decisions which have been given by me in slide, one new decision has come from Madras High Court. All these decisions are still valid decisions even as on today. There is only one Chhattisgarh High Court decision which is against the SSE. So no amendment is proposed with respect to that particular controversy. Some of the minor changes with respect to the procedure of assessment, I will not just deal for the purpose of discussion. I'll be leaving all these changes in my presentation for your benefits. I'll come to the important one. Yes. So a time limit for issuing a notice of reassessment. As we all know, just last year itself, all these provisions were amended. Earlier, the time limit was 6 years, subject to that condition that income escaping the assessment should be more than 1 lakh. Now, 1 lakh was very small amount. So last year, the amendments were proposed that the reassessment notice, it is possible for the department to serve only within a period of 3 years in normal cases. Notice can be served beyond 3 years and up to 10 years only in cases where the income escaping the assessment is found to be more than 50 lakhs and not more than that. So these were the provisions, existing provisions for the purpose of for the purpose of time limit for issuing notices under section 148. Two important things which are required to be noted out of this present provision is that the first condition was that the income escaping the assessment should have been represented in the form of some asset and not otherwise. So in the absence of this condition being satisfied, the reassessment notice could not have been issued. So for example, if we are talking about taxability of some notional income from house property, notional annual value. Now, since this is not represented by any asset, this condition is not satisfied. So this was a condition which was made applicable. And further, the second point is that this threshold limit of 50 lakhs was to be seen for that year. That means for the same year for which the notice is proposed to be issued under section 148. Now, at both the places, there is a change. Look at the change which is now proposed in this provision is that the income escaping the assessment now can be represented not only in the form of the asset, but even if it is represented in some alternative forms, even in that case, now the notice can be issued. So what are these alternative forms? The income escaping the assessment could have been represented in the form of some expenses in respect of some transactions or expenses for some event or some occasion, or The income escaping the assessment alternatively could be the one which is represented in the form of some entries in the books of accounts. So even on the basis of entries in the books of account is something wrong which is found, even in that case, the notice under section 148 now can be issued. That is the impact of this change. This is fine. We don't have much issues as far as this first change is concerned. Look at the second change. The words for that year has been omitted. So now it implies that this threshold limit of 50 lakhs, this condition need not be satisfied for that year, 1 year for which the notice is proposed to be issued. If this condition of threshold limit of 50 lakhs is getting satisfied for multiple years taken together, in that case, also the notice can be issued under section 148. So that is the impact of this change. And what I'm saying that this condition of threshold of 50 lakhs now can be seen for more than one assessment year is further getting supported by this new subsection 1A, which has also been inserted in 149, which says that in a case where income escaping assessment for more than 50 lakhs, which was represented by that asset or expenses, etc., is found in a case where the investment in those assets or expenses for that event, etc., have been spread over more than 1 year. In that case, notices for all the years are required to be issued. So the subsection 1A itself is making a reference of income escaping assessment for more than 50 lakhs, which is spread over more than 1 year. So this indirectly supports that view. So in a way, what is happening is that earlier, since years, we have that limit of 6 years in a case where the escaped income is just more than 1 lakhs. Last year, a proposal was made as if it was a big change in favor of the taxpayer, that now the reassessment notices will be issued after 3 years only if the income escaping the assessment is found to be more than 50 lakhs. Just last year. And just within 1 year, there is a change which is made silently, that now this limit of 50 lakhs need not be seen only for 1 year. This limit of 50 lakhs can be seen for multiple years within this 4th to 10th year. And if all other conditions are satisfied, the notice under section 148 now can be issued for all the years which are involved in this particular case of a reassessment. Few other changes as I've just clarified, I'll not just look at. Yeah, exemption with respect to COVID-19, this also I'll skip because this is in a way not a new announcement. This exemption was already announced by a press release under which was issued in the month of June 2021. Corresponding changes in the act have now been made by providing an exemption with respect to perquisite provided to the employees under section 72 for medical treatment of himself or any of his family member, and another amendment in section 56(2), both the amendments where some compensation is received for a medical treatment or for compensation received on death of any family member due to this COVID-19 illness, subject to the threshold of 10 lakhs. If that is received from a non-employer, this exemption will be available. So corresponding change has been made in section 56(2). Coming to the last set of amendments, which are mainly dealing with the disallowances provision. So 14A disallowance, I'll just skip because it is not practically applicable now because dividend income has become taxable. But in cases where the assessments are pending or some appeals, etc., are pending, this amendment might be of some effect. That itself is an issue because this amendment is introduced with effect from 1st of April 2022. But explanation, it says that it is for removal of doubt and it is a clarificatory amendment. So what is that amendment? If I simply summarize this amendment is that at present we had number of High Court decisions taking a view that in order to apply disallowance under section 14A, first of all, there has to be some exempt income earned in the very same year. And therefore, in the absence of any exempt income earned, 14A disallowance was not applicable. Now, this amendment is trying to overrule these decisions by providing a clarificatory explanation that the disallowance under 14A will apply if the expenses have been incurred, irrespective of whether exempt income has been received or exempt income has been earned in that particular year or not. That is a simple amendment which has been proposed in 14A. Disallowance of education cess. There were High Court decisions, including Bombay High Court decision, taking a view that only tax and surcharge is required to be disallowed while computing the income, but cess paid under the Income Tax Act can be claimed as a deduction. It need not be disallowed. So I'm not going in the reasoning of this view which was taken by the high courts, but now there is an amendment to overrule all these decisions, and explanation has been added in 48.2, which once again is for removal of doubt, and here it is expressly inserted with retrospective effect right from AY 2005-6, that is from the first assessment year from which this cess was introduced. And it says that tax, surcharge as well as cess, nothing will be allowed as a deduction while computing this business income. Another amendment which is dealing with disallowances with respect to freebies which are provided by pharma companies to the doctors. Since this is an important amendment, I would like to spend just 3-4 minutes for the purpose of explaining this amendment. What had happened was that section 37(1) provides disallowance of any expenses if these expenses are incurred for the purpose which is considered to be an offense under any law. These expenses cannot be claimed as a deduction. Now in 2012, CBDT came out with a circular that look, IMC has provided some regulations or guideline wherein it prohibits the doctors from receiving any kinds of benefits or freebies from the pharmaceutical companies or referral fees, etc. And therefore CBDT said that this is something which is not permissible under IMC's regulation, which is also nothing but a law. And therefore, if pharma companies are incurring expenses for this purposes, the expenses will not be allowed. The Association of all pharma companies challenged the validity of the circular before the High Court, but High Court upheld the validity of the circular. Now, in spite of this background, several ITAT decisions of late had allowed a deduction of these expenses to the pharma companies by taking a hyper-technical interpretation. The reason for allowing the deduction in spite of all this to pharma company was that they said that look, the restriction is on doctors to receive this. IMC doesn't have jurisdiction on pharma companies. They can have jurisdiction to regulate only the doctors. And therefore, there is no restriction on pharma companies to pay this or to provide this. And therefore, in the absence of any such law which restricts the pharma companies from paying these referral fees or providing these benefits, etc., or freebies, etc., to the doctors, the expenses cannot be disallowed. Recently, a Mumbai Tribunal Honorable member Mr. Pramod Kumar extensively discussed this concept and took a view that something which is not permitted in the hands of the recipient to receive, we can't take an interpretation that the payer can make the payment of this and or can provide this particular benefits. It's two-way. Okay, there is always two sides of the same coin, and therefore that restriction should be made applicable even in the hands of the payer. Now, confirming this view, an explanation has been added once again for the removal of doubt, which says that if receiving of some benefits or perquisite is prohibited in the hands of the recipient, then the person who is incurring the expenses on providing for this benefits or perquisite, these expenses also will be considered as an expenses incurred, which is considered to be an offense or something which is prohibited by law. So indirectly, it means that the pharma companies will not be allowed to claim expenses, deduction of all these expenses which are incurred, which they are not permitted as per this IMC's regulations. Further, they have clarified that this disallowance of expenses will apply even in a case where the expenses have been incurred, which is considered to be an offense, not only under Indian law, but also under the laws of some foreign countries. And even the compounding fees which is paid if for curing those offenses, even this compounding fees cannot be claimed as a deduction. So for example, builders are constructing their project and in some cases the regulations of local authorities have been violated, and as a result they have to pay some compounding fees. So this payment of compounding fees is also not deductible now. The issue will arise as to whether this amendment can be made applicable with retrospective effect. I think similar amendment was proposed last year for employees contributions disallowance under 36(1)(5)(a) and 43(b), and where already views have been taken by several tribunal decisions, first by Hyderabad Tribunal in the case of Sales Guitar, to say that though explanation is worded that it is for the removal of doubts, etc., but if the explanation has been inserted with a particular date, that cannot be made applicable to the prior assessment year. 43(b) amendment is little simpler one. which says today already we have a provision which says that interest which is eligible for a deduction only on a payment basis if the interest is payable to certain entities like banks, etc. Today already we have a provision which says that if the interest is converted into a loan, that conversion of interest in the loan will not be considered as a payment for this purpose. Now there is a further amendment which says that if the interest is converted into some debentures or such other instrument by which the liability to pay is deferred, in that case, this conversion of interest into such debentures or other instruments also should not be considered as payment of interest for this purpose, and deduction under section 43B cannot be granted. Bonus stripping, section 94(8). Today, these provisions are applicable only to units of mutual fund. Now there is an amendment which is proposed to make it applicable to all types of securities, and therefore even in case of transaction in shares, this amendment will apply. And what is this provisions of bonus stripping? Just to summarize, since now they are becoming applicable even to bonus shares, this provision provides that if the shares, or rather for that purpose, any securities or units have been acquired within a period of 3 months prior to the record date of bonus and sold within a period of 9 months after the record date of that bonus, and if the loss is incurred on the original holding, purchase and sale of original holding, that loss will not be allowed as a set-off. That loss will have to be ignored, and in turn that loss will be made as a the benefit of that loss will be given by making that loss as a cost of these bonus units. So the cost of bonus unit will not be zero, but that loss would be considered as a cost of this bonus units. That will be the impact of including securities, that is mainly shares, within this provisions of section 94(8). The organizers had asked me to deal with the amendments specifically made for the taxation of trust. I was very sure that within this limited time period, it will not be possible for me to deal with this amendments dealing with trust. So I'm leaving these amendments in my presentation, friends. You can just go through this amendment. I'll just see if there are any other amendments which I've just missed out. Yeah, the one which is very important is penalty under section 272A. Today, for some of the violations which are provided under subsection 2, there is a penalty of 100 rupees per day. There is a proposal to increase this penalty 5 times. Now this is going to be 500 rupees for every day of default. And what are those defaults? There are a number of other defaults which are covered by subsection 2. But just to point out is that if there is a delay in issuing TDAs or TCA certificates, now the penalty would be 500 rupees per day. If there is a delay in furnishing the data related to 15G, 15H, that is declaration under section 197A, there would be such a penalty of an amount of 500 rupees per day. There is an extension of timeline for the purpose of section 115 BAB. So a company which is a domestic company and engage in the business of manufacturing or producing some article or thing, a concessional rate of tax of 15% was made applicable to them, provided other conditions are satisfied. And one of the conditions which was required to be satisfied was that the manufacturing or production activity should have been commenced by 31st of March 23. So now this commencement period is extended by 1 more year due to this COVID disturbance, etc. And therefore now the companies, even if they are able to commence their manufacturing activity by 31st of March 24, even in that case, they would be considered as eligible for the purpose of availing this concessional tax regime by paying tax at just 15%. A similar extension is given to a startup, that even if you are incorporating any startup entity, not just by 31st of March 2022, but even if you are incorporating any startup entity by 31st of March 2023, even in that case, you will be eligible for availing the benefit of a tax holiday, which is available under section 80 IAC. So friends, that's all, and thank you very much to the organizers as well as all the participants for patiently hearing my analysis on the important provisions of the Finance Bill 2022. At the same time, I'm sorry because I could not deal with the remaining other provisions, mainly the amendments dealing with the trust, because it doesn't make, according to me, it doesn't make any sense in just dealing with the provisions and just giving an overview. I always feel it better that if at all we want to understand, we should understand all the provisions in details. Okay, that will serve the purpose. So I'm sorry, friends, for that. With this, I leave the charge of this proceedings to the organizers. Thank you very much.
Thank you, Bhadresh bhai. Uh, you have always been a master blaster. We would like to say for the other CP study circle and in your core subject, direct taxes. So coming to the pleasant vote of thanks, task of vote of thanks for today's evening. Bhadresh bhai has always accepted our request. Thank you this time also to accept our request for the coming to the Dadari CP study circle and enlightening us with the budget amendments. Bhadresh bhai has already given very well detailed explanation. Yes, Sanjay bhai has written in the chat box too that perfectly detailed explanation. And when we had a talk that he has assured us that yes, each and every provision he would be taking it in detail, and that's the perfect way to explain the provisions. Bhadresh bhai, nothing. This thing we would share the presentation with the members and the participants. Definitely, everyone will be having a benefit from this thing. On behalf of Dadari CP Study Circle, we thank you for accepting our invitation and propose a well-deserved vote of thanks for today's evening lecture. Thank you very much once again.
It was my pleasure, and thank you too.
Thank you, Bhadresh bhai. Thank you.
Welcome.
Hello, Bhadresh.
Thank you, sir.
Yeah, thank you so much to all of you.